Welcome to the third and the last day of National Conference on Auditing and Assurance Standards. After 2 successful days, now it's time to sum up the things, and it is our privilege to have with us the Khushroo Panthaky sir with us. To begin with, may I now request Chairman of Nagpur branch, Saket Bagdia ji, to kindly address the gathering. Saket sir, over to you.
Thank you so much, Akshay. A very good morning, respected dignitaries. The learned speaker for today, CA Khushroo Panthaky sir from Mumbai. A very important topic to cover for today. I feel this is the most important topic because after learning for 2 days, now forming an opinion on the financial statements is the thing that has to be done. And that's the reason that is being kept today. And I feel that is the most important part because whatever we do, ultimately our outcome is that opinion, the forming of an opinion. So really thankful to Khushroo sir for sparing his valuable time for deliberating on this very important topic. And thereafter, we are going to have a panel discussion. The panel discussion is going to cover, is going to be deliberated by 4 speakers: C. Amarjit Chopra ji, past president of ICAI; C. Shriniwas Joshi ji, the vice chairman of this Auditing and Assurance Standards Board; C. Aniket Talati ji, the central council member; and C. Ashutosh Joshi ji from Nagpur. Friends, all the things which we have learned would be covered, summarized, the issues, the concerns, the precautions that are required to be taken would be covered in that panel discussion. So I request all of you to really enjoy this third and final day. As discussed yesterday, I'm going to prepare a WhatsApp group for the benefit of all the participants. I will share the link in the chat box of this chat box so that people can join on that WhatsApp group. So that whatever the presentations are there, we can also share the presentations as well on that group and for future coordination as well. So thank you so much. I welcome Khushroo sir again virtually to Nagpur branch. It's always been a pleasure for Nagpur branch to welcome him in a physical mode, but yes, for the first time in virtual mode. So thank you so much, sir. We welcome you. I welcome all the delegates to this session. Over to you, Akshay.
Thank you so much, Saket sir. Friends, Khushroo sir need no introduction, but to briefly introduce him, sir is a fellow chartered accountant with 37 years of experience in accounting, auditing, and financial services. He is currently a senior partner with Walker Chendyok and Company LLP, a related party of Grant Thornton. Khushroo sir is a member of the partnership board of the firm and heads its western region as a territory senior partner. He is also the national head of banking and financial services industry vertical within the firm and is responsible partner for the public policy matters of the firm. Khushroo sir has an extensive experience both locally and internationally in auditing and advising large corporates and multinationals. He has attained understanding and knowledge of local as well as international accounting standards and auditing standards, corporate governance, internal control, risk management, banking, insurance, financial services, and whatnot. He has completed a diploma in insurance from Devon Business School in Virginia. He graduated from Sydenham College of Commerce and is a Bachelor of General Law. He is an eminent speaker in many workshops, seminars, as well as conferences. Khushroo sir, we welcome you on the forum of Nagpur branch and eager to listen to you. Over to you, Khushroo sir.
Thank you, Akshay. Thank you very much. Am I audible? Thank you very much. So at the outset, I really thank Saket Bagdia ji for welcoming me and requesting me to speak on auditing standards on reporting at the Nagpur branch. I remember that many years ago, I used to come very regularly, once a year or twice a year. Zulfesh bhai, of course, used to sort of interact with me at that point of time. So indeed a pleasure to be back again. And I think nothing better than this time in the morning when I can still see quite a few individuals out here who are interested in learning about auditing, very early morning. So thank you for the opportunity and thank you, Akshay, for my introduction. Really appreciate it. We have about 1.5 hours to cover this particular topic. And I believe that I would be able to do justice on that, given that there are 3 standards. This particular topic is extremely important since now we are actually ushering into a real busy audit season. Most of you would have also completed the audits of private companies, listed companies, etc. but still we have about a couple of months or maybe 1.5 months to go before we sign off 31st March 2021. And therefore, it is very important for you to be refreshing your knowledge on the auditing standards that relate to financial reporting, which are basically 700, 705, and 706. I know that 701 equally is an important topic in terms of communicating the key audit matters, but I understand that this standard may not be completely relevant at this point of time. So I'm covering 700, 705, and 706. Friends, as an auditor, we have a responsibility on the audit report. First of all, the financial statements are prepared by the management, and it is the responsibility of the management to adhere to the recognition and measurement principles of accounting when they prepare the financial statements. But as an auditor, we need to audit the financial statements. The management also has another responsibility of presentation and disclosure. And the auditor has a responsibility to ensure that these presentations and disclosures are in line with the standards. So some people feel that only recognition and measurement is important. If at all the presentation and disclosure is may not be appropriately done and all, it's still okay, chalta hai kind of, but I don't think so. Because when we are actually getting reviewed either by the quality review board or by any other regulator, the presentation and disclosure requirements have equal importance, and therefore we should never underestimate their significance. Having said this, ultimately everything culminates into an audit report. And when we talk about an audit report, in India, the audit report is one of the, or I would say rather the lengthiest in the world, because we have got an audit report which runs into initial opinion of around 3-4 pages, followed by a Karo opinion, and followed by an opinion on internal controls over financial reporting. So given the fact that we have got the main opinion, Annexure A on Karo, Annexure B on internal control on financial reporting, I think this becomes very, very lengthy. And therefore, every word that you write or every word that you actually compile into the audit report is definitely a very, very important document. And therefore, one has to be extremely careful about this. I have reviewed the financial statements as a part of the FRRB review board. I have reviewed it. I have gone through many, many financial statements, and with utmost humble submission, I would say that I have seen apparent errors in the audit report. In fact, you will be surprised that I've seen an audit report by mistake, which was jointly signed by the client and by the auditor. It was a mistake. But I have seen such things happening in the past, and therefore we need to be very, very careful on this particular deliverable, because this is your deliverable and not the deliverable of the management. And therefore the audit report is your responsibility, and you need to make sure that everything out there is completely appropriate, relevant, and factual. Then there are audit reports where somebody takes a different view. If at all there has to be a qualification, somebody will give a clean opinion. If at all there is a qualification, somebody will convert into a para of emphasis, because there can be various pressures coming from the clients. And therefore, it is important for you to do the right thing, because these ultimately get challenged during the course of the regulatory review. And at that point of time, your client is not going to come and salvage you. It is ultimately you who would be responsible for whatever you have written in the audit report per se. So friends, I think this is basically the backdrop that I wanted to share with you. We have a very limited time of 1.5 hours. I can keep talking about generic mistakes that I see in the audit reports, but let me just sort of, quickly take you through the presentation, which is there on the audit reports per se. I've just uploaded the presentation. Saket, can you see the presentation?
Yes, sir. Yes.
Okay, it's come up, right? Yeah, great. So we are going to touch upon these 3 standards. I am not covering 701 at this point of time because that is not required to be covered. So I will not touch upon that. And these are basically effective 1st April 2018. So we have been using these particular standards for a fairly long time now. It's been almost 3 to 4 years that we have been following these particular standards. SA 701, as I mentioned earlier, is the one that we are not taking up right now. So let's come out with 700. which was in the earlier avatar being called as SA 700, which was AAS 28, Auditing and Assurance Standard 28. It is the auditor's responsibility to form an opinion. It deals with the form and content of the audit report, and it ultimately makes sure that there is a proper balance between the consistency and comparability of the auditor with the reporting globally. What was the need of changing the format of the audit report? If you look at the international audit reports, they were earlier very much condensed, like, one page or 1.5 page of audit reports. But now even internationally, the audit reports are more exhaustive after the scandal that happened in one of the companies, which was Enron at that point of time, as a result of which the audit reports have become much more informative. And therefore, if India has to be seen as a destination of a significant global investment, then even the financial reporting of the companies which invite the global investments need to ensure that the audit reports are actually scaled internationally to a different level. And that's the reason why you need to have consistency with the global standards. It ultimately has to promote the understanding of the user in getting the best and the most appropriate information, and to identify what could be the unusual circumstances which have been reflected in the audit report and which could be sort of impacting the financial statements of the company. So ultimately, it is an evaluation of all the conclusions that you have reached during the course of the audit, basis whatever evidence that you have obtained. And whatever you have obtained, it says very clearly that you need to communicate very clearly in the audit report. So whenever there is a qualification or a modification, it says very clearly that whatever you need to mention should be very clear, should be very concise, so that there is no misunderstanding in terms of interpretation of what you have given. I'll spend a couple of minutes on general purpose financial statements and the financial reporting framework. The financial statements which are prepared by the management in line with the schedule prescribed under the Companies Act is meant for the public at large. If it's a listed company, it is there in the public domain. If it's an unlisted company or a private company, you can always seek such financial statements by paying an appropriate fee from the Ministry of Corporate Affairs or from the ROC. And therefore, these are the financial statements which are meant for a general purpose. It could be meant for the purposes of submitting to the bankers, to the income tax department, and to any other regulator. And therefore, the purpose is generic. And therefore, these are called general purpose financial statements. And therefore, whatever we are going to learn right now is on the audit report, which is attached or which relates to the general purpose financial statements. Similarly, the general purpose framework is the framework within which the financial statements of the company are prepared. It can be a general purpose framework, which could be a fair presentation framework, which means that the financial statements present a true and fair view and have been presented in a particular manner in line with the schedule that is prescribed under the Companies Act. Or it could be a framework, which is a compliance framework. For example, in the case of, say, a bank or an insurance company, there is a compliance requirement. And therefore, the financial statements are a little different from what we have under the Companies Act. And therefore, that particular framework gets a particular higher recognition compared to the framework in the Companies Act, because you need to comply with those regulations. And therefore, those are called the compliance framework. And finally, when we talk about an unmodified opinion, we use the words qualification and modification very loosely. So now onwards, I will be, and even you should be, using the word modification rather than the word qualification. Modification means that any change that has happened in the audit report is called a modification. And then there are three different types of modifications. One is, of course, a qualification, a modification. Can you keep it on mute, please, all of you? Thank you. Thank you. One particular modification is in the nature of a qualification, which means that you can just qualify the audit report. The other modification could be in the nature of disclaimer of opinion. And the third modification is in the nature of an adverse opinion. And therefore, we should not be using the word qualification, but we should start using the word modification per se. As I mentioned, the fair presentation framework. A fair presentation framework is to provide disclosures in accordance with the requirements of the Companies Act And many a times we decide that in order to promote better understanding of the financial statements, to give the users of the financial statements an opportunity to go through and read beyond, you can pick up some of the requirements of the disclosures of the presentation from the international financial statements. And therefore, if at all you believe that you need to go a little more, then you can go a little more and present in the financial statements. And therefore, it is basically called as a fair presentation framework. I will not spend too much of time because my ultimate goal is to give you an understanding on what kind of modifications are there in the audit report, which is covered by 705. But I will talk about this particular standard also very much in detail. And therefore, the financial reporting standards under this particular standard of auditing. When we talk about financial reporting standards, we refer to the accounting standards, which are issued by the Institute of Chartered Accountants and now forming part of the Companies Act, which is under section 133. And therefore, 99% of the time, we refer to the financial reporting standards under the Companies Act. But there can be financial statements which can refer, but there can be audit reports, which can refer to two financial reporting standards. One could be the Indian accounting standards or the Ind AS or simple Indian GAAP. And the other could be IFRS, or it could be any other standard. For example, there are companies who prepare the financial statements under Ind AS and under Indian GAAP, both. One could be mandatory, the other could be voluntary. And you can even have one audit report covering both this particular financial statements, which are prepared under different GAAP. So please do not mix up the word GAAP, which is generally accepted accounting principle, and the word GAS, which means generally accepted auditing standards. Even we mix up those things as well. Very elementary. GAAP is your accounting standards and GAS is your auditing standards. You prepare the financial statements either using the local GAAP or the Indian GAAP, what we say, or it could be Ind AS in case if the company is a listed company, or if the company is basically a company which is into a threshold or which has met the threshold of preparing the financial statements under Ind AS. And therefore, when you prepare these two financial statements, one is mandatory and the other is voluntary, you can have only one audit report covering both the standards, and we'll talk about that later. This you may not have heard it before, but there is a provision under the auditing standard which allows you to have one audit report for both the financial reporting financial statements. So when we talk about this opinion on the financial statements, what are we talking about the opinion? It says that whether the financial statements are proper, they're properly prepared, they are in line with the financial reporting framework, whether the auditor has got reasonable assurance. Friends, we as an auditor talk about reasonable assurance. We never provide absolute assurance because you can never audit 100% of the transactions of the company. You always do your test checks, you carry out a sample testing, and therefore it is never an absolute assurance. Again, over here, it's important for you to understand what is reasonable assurance and what is absolute assurance. Reasonable assurance means some level of assurance. Definitely, it is a higher level of assurance, but it is not an absolute assurance. You cannot give any absolute assurance unless the standard requires that in the case of certificates, we may be required to give an absolute assurance, which means that normally for a certification, you are required to carry out more detailed testing and you are required to carry out almost 100% checking before you certify anything. Because the moment you use the certificate, it means it's absolute assurance. And therefore, there is a difference between reasonable assurance and an absolute assurance. While you are doing an audit, you are required to give or required to provide reasonable assurance that the financial statements are free from material misstatement on account of any fraud or error, which means that financial statements may have small levels of errors or there could be small amount of frauds here and there, provided that they are not very material and would not be causing any material misstatements, which means material errors or material omissions. And therefore, this is the exercise as an auditor that you are responsible for, to provide a reasonable assurance as to whether the financial statements are free from material misstatements on account of fraud or error. And therefore, in order to provide such an opinion, you need to obtain sufficient and appropriate audit evidence, because you need to have the audit evidence in place to sign off an audit opinion. And you also need to conclude that if at all there are any errors or there are any omissions, then in that case, the total impact of such errors and omissions, when you aggregate, because you have not corrected those errors or corrected those omissions, you can actually have a materiality threshold that below a particular amount, I would not want to make a change. Now you aggregate those amounts. Some of them could be having a positive impact on the financial statements. Some of them could be having a negative impact on the financial statements. But when you aggregate such financial errors and omissions, ultimately you come to a particular number. And if that particular number is below your materiality threshold, you may not be required to make adjustments to the financial statements. And therefore, you have concluded that the uncorrected misstatements and errors individually or in aggregate is not material. And finally, while signing off the financial statements, you are required to evaluate some of the positions that you have taken so that you know the ultimate impact of that is not material on the financial statements. Some of the slides are repetitive in nature, and therefore I will just skip. They are not very important. While carrying out the audit of the financial statements, accounting policies need to be followed consistently. First of all, there is a disclosure on the accounting policy. Then if at all accounting policies remain consistent, which is fantastic, you actually would review the application of the accounting policies. In the event that there is a change in the accounting policy, then you need to determine the reason for the change. Many of us will not question the reason for the change in the accounting policy. We just see kitna change hai, kitna impact aa raha hai. If it is material, we would like to disclose. But understand the rationale and the reason as to why the client has changed the accounting policy. It could be for a genuine rationale, where the client may really believe that a particular asset needs to be depreciated in a more appropriate manner, or the inventory needs to be valued in a more appropriate manner, taking into consideration some of the circumstances and the facts. But some clients may want to change for meeting their own purposes. They may want to understate the profit or overstate the profit. And therefore, the only thing that they can play with is changing the accounting policy. And especially those policies where there is a lot of subjectivity, like depreciation, like inventory valuation, etc. And therefore, these things need to be properly evaluated and reasoned out. So one is, of course, your significant accounting policies. And second is, of course, your accounting estimates. Your accounting estimates actually is basically an accounting estimate that the client has taken into consideration basis the judgment and the estimates made by him. And as a result of which, if these accounting estimates have to be looked into, then they need to be looked into from a consistency standpoint, that whether the estimates are prudent, whether they are reasonable, and whether they are in line with the accounting principles. And if at all there is any change in the accounting estimate, then that change also has to be questioned. The information that is presented in the financial statements is relevant, reasonable, and comparable, which means that it has to be comparable with other financial statements. It has to be comparable with one period and the other. It should be easy to understand, and it should be reliable. When we say reliable, it is the duty of the auditor who signs the financial statements to make the users of the financial statements believe that the information is reliable. And finally, the financial statements have to provide adequate disclosures in relation to all the impact of the material transactions and events. So for example, if at all there is an unusual transaction, or if there is a material event, or if at all there is an event which is basically exceptional in nature, then you need to bring out the effects of those things separately in the financial statements, because it could be a one-off item. It could be an item which is not there in the previous period. It is material to the financial statements right now. And those things have to come out separately in the financial statement, because see, ultimately it's basically common sense that your information has to be consistently comparable from the current year with the previous year. But in the previous year, if there is something which has not happened and has happened in the current year, then you need to bring out that particular point very clearly by way of an appropriate disclosure in the financial statements, either on the face of the P&L account or the balance sheet, or in the notes to accounts, or in the schedules, wherever you want to give. And therefore, you need to bring out these unusual effects very clearly in the financial statements. So as a financial reporting framework, which is a fair presentation framework, you need to ensure that the overall presentation and the structure and the content of the financial statements is in line with the Companies Act schedules, and your related notes which represent the underlying transactions and events have been disclosed in a manner in which they need to be disclosed so as to be called as a fair presentation. And when I say fair presentation, means the appropriate and the right presentation to bring out the effects of these transactions in the financial statements. So now, if you look at this particular picture, look at the lady, she's very happy. And this is basically the happiness of the client, that you give an opinion, which is an unmodified opinion, means clear opinion. But trust me, it is not only the client who gets happy when you give him a free opinion or an opinion without any modification, but even as an auditor, you have the pleasure, if you have done a proper audit, you have given an opinion which is an unmodified opinion or a clean opinion, you have the same pleasure. Friends, I want to make a point very clear. One point, that whenever there is a potential item which has not been properly accounted for, or which has not been properly disclosed or not accounted for, the duty of the auditor is to convince the client to account it or to disclose it in the most appropriate manner. Then if the client is not agreeing to that, you need to actually convince the MD or the CEO of the company. And if not, then you need to convince the audit committee. Some companies may not have an audit committee, some companies have an audit committee. But the important point here is that the auditor should make sure that he has done everything possible to convince the client to do the right accounting or have a right disclosure, because that will entail a clean opinion. It is never good to give a modified opinion to a client unless the client is not agreeing on the accounting principles for recognition and measurement or for a presentation and disclosure. Most important thing is your ability to convince someone to get a clean opinion. But never ever, for whatever reason, get convinced otherwise, whereby the client convinces you, कि no Baba, there is no risk in giving a clean opinion. ये कौन देखने वाला है? कोई पूछता नहीं है, कोई देखता नहीं है. छोड़ दो, हम लोग next year में account कर लेंगे. Never do that. If the client does not agree with you for whatever correction has to be made in the financial statements, then it is your duty to assess the impact. If the impact is going beyond the materiality threshold, then you need to give a modified opinion accordingly. And therefore, your modified opinion, which is covered under 705, has got two different kinds, which I'll come to that later when we are actually seeing. So look at the picture over here. I mean, the client is very, very unhappy. He feels defeated when an auditor will give a modified audit opinion. And this is the case. Normally, I believe that it also reflects upon the convincing ability of the auditor to convince the client of not going for a clean opinion. So make sure that to a great extent, the client is satisfied with whatever you have convinced him, and make adjustments, ask him to make adjustments to the financial statements so as to ensure that the opinion is clean. And therefore, there are different kinds of opinions. There is an opinion under 705, which I'll come to later in terms of modified opinion. Now, what is my audit report? An audit report is a report which is in writing, which we all know. It has a title very clearly given. It is addressed to the shareholders generally or to the people to whom it is being addressed. And finally, you have a para on the opinion. In the opinion paragraph, you know that there is a name of the entity. This is all basic, so I'm just covering it as a matter of refreshing you. It is basically the name of the financial statements has got the name of the company, the period for which the financial statements have been audited, and then there is a title for every particular paragraph in the financial statements, which you know. Then there is a reference to the notes and the notes to accounts, etc. And then you have got your the date on which the financial statements are, or the period which is covered, and the date on the audit opinion. These are some of the slides which are talking about the same fair presentation framework. I would not want to spend more time. So I'm only skipping out those slides, friends, don't worry, which are not very relevant or which are repetitive in nature. Now we have got a new particular section in the audit report. Now, when I say now, means it was introduced 3 years ago when this particular standard was sort of finalized. And that is basically the paragraph on the basis for opinion. When I say about the basis for opinion, I mean that on what basis has the auditor given an opinion? What is the basis of his opinion? Under what circumstances has he concluded as to what opinion the financial statements have given. And therefore, this particular opinion is required to be preceding the basis for opinion. If you look at the new financial statements right now, the first paragraph in the financial statements is the opinion paragraph. Things have changed, and I will give you a comparative analysis between what was prevailing earlier and what is prevailing currently. So if you look at the financial statements now, it starts with the opinion. At the outset itself, you say that whether the financial statements give a true and fair view and whether they are free from misstatements. And then you come to the paragraph, which is called the basis for opinion. After doing everything possible, one gives an opinion. And the basis for opinion means after what evaluation has the auditor given the opinion. And therefore, the basis of opinion paragraph will talk about whether the audit was conducted in line with the auditing standards, whether the auditor is independent in form and substance of the entity in line with the ethical requirements relating to the audit, which means that whether he is independent in form and substance, and whether he has got all the evidence which is sufficient and appropriate to provide a basis for the opinion. And this is a very, very important thing, because whatever you receive during the course of the audit is your audit evidence. And you need to evaluate the audit evidence. You need to examine. You need to have a professional judgment on that audit evidence, basis your professional skepticism that the evidence is of the best quality, it is reliable, and it is appropriate and adequate for you to form an opinion on the financial statements. And therefore, these things get covered under the basis for financial statements. Now, under the audit report, you are also covering a section called your assessment of management's assessment on going concern. So one is that it is the management who has the primary responsibility to ensure that the entity remains as a going concern, and the management has to do the assessment of a going concern. And then finally, the auditor has to evaluate that particular assessment on the going concern. What is going concern? It talks about under sections 570. Very simple words is that whether the company will continue to exist 1 year down the line, which means that I'm just giving an example, that if I'm signing the financial statements for 31st March 2021, I need to ensure as an auditor as to whether the entity will continuing its business, continuing its operations, and continuing its existence till 31st March 2022. You will ask me this question that, as an auditor, how would you know that? I'm not supposed to be knowing that, but actually I will expect the management to do that particular assessment. And after the management has done that particular assessment, Standard on Auditing 570, which is a revised standard, talks about certain things which will help the auditor to do that particular assessment on whether the entity will continue to be a going concern. And therefore, that particular assessment, you need to ensure in entirety for you to form an opinion on the assessment of the management as to whether it is appropriately assessed by the management that the company will continue to be a going concern, which means the company's existence will continue. And normally there are certain triggers that happen. I'm not talking about 570 right now. That's a different standard altogether. There are certain triggers, for example, diminishing net worth, diminishing profits, a significant event that has happened which has completely distorted the financial ability of the company to continue to be a going concern. And therefore, there can be thousands of reasons as to why the company believes that it may not continue to be a going concern. And when the company believes that it is not continuing to be a going concern, the financial statements are prepared in a different manner by basically using the fair valuation of assets and liabilities. Because a year down the line, the company may not be even existing, or it may not continue to be a going concern. And therefore, there is a different kind of a reporting that the management will have to do. And the audit procedures are also applied differently on the financial statements, which are reflecting that the company's assessment on going concern believes that the company may not continue to be a going concern. And therefore, this assessment of the management and of the auditor is very, very important. So now we talk about specific purpose financial statements or general financial statements. Generally, in the case of listed entities, the auditor has to report on general purpose financial statements. And then there is 701, which we are not covering for this particular presentation because that is communicating the key audit matters to those charged with governance and in the audit report. This is not forming part of the standard, so I will just skip this particular thing. Now we come to management responsibility. Very clear. I'll just take a couple of minutes out here. The responsibility of the management is to ensure that there are adequate internal controls within the company and within the financial reporting framework. And the responsibility of the management is also to ensure that the financial statements are free from material misstatement. Recognition and accounting principles, recognition and measurement principles, presentation and disclosure requirements, all are basically the responsibility of the management. Proper adoption of financial reporting framework is the responsibility of the management. Entity's ability to continue as a going concern is the responsibility of the management. So please do not pick up that responsibility. As an auditor, please make sure that you are independent in form and substance. There are firms, with due respect, who love to do the audit and who love to prepare the financial statements and who would like to write the books of accounts. You may call me a math person over here giving you that particular gyan. But friends, please follow the code of ethics prescribed by the Institute of Chartered Accountants, where as an auditor, you are not required to prepare the books of accounts of the client. In case if at all at any point of time somebody blows a whistle, or if at all the regulators come to know that you are doing a dual function of preparing the books of account and auditing a company which is a limited company and signing off, then your complete independence is impaired. What you are giving in the audit report that you are independent in form and substance will be completely incorrect. And therefore, you should not be indulging into the accounting function and the audit function. Let the books of accounts be prepared by somebody else. Let the financial statements be prepared by somebody else. Your duty is to audit the financial statements. But however, during the course of the audit, if there are errors or if there are certain corrections to be made in the notes to accounts, or if the note needs to be properly drafted, you can help the client in doing that much. But you are not required to prepare the financial statements. And therefore, please do not accept that particular responsibility, because that responsibility is of the management and not of the auditor. Now you have the auditor's responsibility section in the financial statements, and that section talks about your own responsibility. So you had the opinion section, you had the basis for opinion section, then you have the management responsibility section, and now you have the auditor's responsibility section. And your section talks about reasonable assurance that you have obtained that the financial statements are free from material misstatements, number one. Number two, it talks about a reasonable assurance, which is a high level of assurance, but it is not an absolute assurance, which we mentioned earlier. Then it talks about the fact that the financial statements are free from any material misstatements, because if at all there are certain errors or certain omissions, in aggregate, the impact of such errors and omissions is not material enough for any adjustments to be made. And therefore, that particular disclosure also comes in the audit report per se. While you are actually reporting on the auditor's responsibility, you also report on the fact that you have exercised your professional judgment and maintained the professional skepticism. Why this particular section on the auditor's responsibility is enhanced under the new standards? Even earlier, we used to have the auditor's responsibility. But I think it is important for the regulators and for the investors and for the readers of the financial statements to be fully aware of two or three things. One is that you are providing reasonable assurance. And when you provide reasonable assurance, you are not required to audit 100%. That comes out very well. Secondly, you are exercising your professional judgment and you are maintaining professional skepticism. Many a times the auditor is criticized for the fact that aapne to fraud ko pakda nahi hai. The regulator also asks this question, that this particular fraud was there, aapne isko kyun nahi pakda? Well, it's not the responsibility of the auditor to detect frauds while doing the audit. However, the auditor is required to ensure that he has carried out robust audit procedures and carried out a fraud risk assessment, because there is a fraud risk in every financial statement. In every company, there is a fraud risk. What procedures has the auditor carried out to mitigate risks arising out of the fraud? And what is the kind of work that he has questioned of the management to mitigate those fraud risks is something that the auditor is required to look into. And if at all the auditor has not carried out such procedures with rigor, then he has failed in carrying out a proper risk assessment, and then he could be responsible for any material fraud that has arisen on account of his negligence. But the auditor is not sitting out there to detect the frauds. That could be the responsibility of the management that could be the responsibility of the internal auditor, but not the statutory auditor. And therefore, the professional judgment with the highest level of professional skepticism throughout the audit is extremely important for an auditor, because he has to have his judgment. Now, your professional judgment can go wrong. It can go wrong in evaluation, but it cannot go wrong without having done appropriate work. So for example, if you have taken a decision on something as a matter of judgment, but if you have not carried out enough audit procedures to come to that conclusion, then you are negligent. And it can be a gross negligence as well. And therefore, you need to report such things very clearly while you report in the audit report on your professional judgment, on your professional skepticism. You also need to ensure that you have obtained audit evidence. The audit evidence is absolutely adequate, relevant, and reliable. And finally, you have done your thorough evaluation basis the skepticism that you have. And now finally, you have assessed the risk of material misstatement, which means that if at all there are certain errors or omissions, whether you have carried out enough procedures to identify such errors and omissions, you have evaluated the impact of errors and omissions, and accordingly you have taken a decision as to whether they need to be adjusted in the financial statements or can be ignored from a materiality standpoint. Then your responsibility is also to ensure that you have obtained an internal control evaluation. You have understood the internal control environment in the company. You have worked towards assessing the design of those controls. You have looked into the documentation which the management has maintained of the evaluation of internal controls. See, operating effectiveness of the internal controls is the responsibility of the management. The management has to make documentation of such operating effectiveness. However, if the management has not done that, it is not your responsibility. Get it done by the management. In many audits, we come to certain conclusions on ourselves. Management will say, "Nahi, barabar chal raha hai, hum log ye karte hain." Now you have relied upon that particular oral evidence. Simple thing, bank reconciliation statement, okay, prepared by somebody, reviewed by somebody, but not the evidence of review is not there. Where is the operating effectiveness of the control? There is a control that the bank reconciliation is prepared. There is a control that the bank reconciliation gets reviewed by another person. But where is the operating effectiveness of control? Which means that has somebody taken the responsibility of signing off on the bank reconciliation? If that is not the case, you cannot rely on that particular internal control operating effectiveness as to whether it is operating effectively or not. I'm just giving a small example. And therefore, it is a responsibility of the management to demonstrate to the auditor that the controls are operating effectively and efficiently. And then the auditor does not have to only rely upon that particular operating effectiveness, but has to carry out certain procedures to gain his own independent comfort that the controls are operating effectively. And therefore, the auditor will do that particular job in order to report under Annexure B, which is the internal control on financial reporting. Ideally, I must tell you that people have to change their mindset. 5 years ago, this particular requirement came up on internal control over financial reporting to be a part of the audit report. Many of us still work in that particular different era. अरे इसमें क्या करना है, इंटरनल कंट्रोल तो पहले भी हम लोग करते थे, इसको खाली रिपोर्ट करना है, छोड़ो ना क्या देखेंगे. Don't do that. You are specifically reporting on internal control over financial reporting. And it is a duty of the auditor to go beyond the normal audit procedures. Normally what we call is an integrated audit approach, which means that while carrying out the audit to give a true and fair view, you are also required to assess the internal control environment of the company. And therefore, to a great extent, see the documentation of the management on design of controls, on the operating effectiveness of controls, and in line with the guidance note on the auditor's responsibility of internal control environment. Look at the procedures that you are required to carry out to understand the internal control environment and to assess the operating effectiveness of the internal control environment. If you will not have enough documentation in your file of carrying out the work on internal controls, then you will be failing in your audit opinion. And therefore, please make sure that you have assessed the internal control yourself as an auditor. Having relied upon the management is one, and having assessed secondly is important. And therefore, in order to sign off on the opinion on internal control, you need to do that particular testing. So I wanted to emphasize on that particular point also. And therefore, your auditor's opinion will have internal controls. It will have the assumption on going concern basis of accounting. You have assessed the going concern basis of accounting, even that is there in the audit report. And therefore, you have all these particular sections coming under the auditor's responsibility or subsection coming under the audit responsibilities. This is just, I'm talking about all those things, of course. Now there are other responsibilities for the auditor in the audit report. And the other responsibilities include among many other things, your responsibilities under CARO and your responsibilities under internal control reporting. So your audit report, as I mentioned at the beginning, is the main body of the audit report, followed by CARO and followed by internal control over financial reporting. Why are these two separate sections? These two separate sections are there because the Companies Act has prescribed additional responsibilities on the auditor beyond the true and fair view to report on certain things, such as whether fixed assets verified by the management are in line with the program that the management has devised for the verification, whether proper inventory valuation has been done, whether the internal audit system is commensurate with the size of the company and the nature of the business, whether the statutory dues are deposited regularly with the statutory authorities, and whether short-term loans are applied for long-term and vice versa. Now, these are responsibilities imposed upon the auditor under a separate requirement, which is called the CARO, Companies Auditors Report Order. And in addition to the auditor reporting on the true and fair view, he has to report on these things, which you all know, of course. And therefore, that particular section is called as a report on other legal and regulatory requirements. And therefore, it is attached to the main audit report. And therefore, it's forming part of this particular reporting section as well. And therefore, you need to very clearly distinguish between the main report and the other reports as well. And your CARO will always follow. I don't have to say that, but the standard says very clearly, the CARO report will always have to follow your main report on the financial statements. Now, when you are signing the audit report, also please make sure that you sign the audit report in line with the requirements of the auditing standard. It has to have your personal name, your membership number, the name of the audit firm, and of course, the registration number of the partner and the registration number of the audit firm. Both we all require. It is also the place where you are signing off the audit report. Now, today, 99% of the signing, at least I can say that given the fact that in the case of listed companies, your financial information after the audit committee and the board meeting has to be communicated to the stock exchanges within a very reasonable 15 minutes period of time. In the case of listed companies, normally the electronic signatures are or electronic sign-offs are happening. But over here, in the case of unlisted companies, such a requirement is not there. But we need to make sure, and I will not talk a little more about it because I will keep going on that. Very, very simple thing, friends, over here. The date of the signing is the date on which the financial statements have been approved by the board or authenticated by the board. Please do not have back and forth communication with the client if the date of the audit committee or the board meeting is decided and if the work is not complete. I'll be very honest with you. Make sure that the work is complete and make sure that the sign-off happens in form and substance on the date of the board meeting. In the event that it is not happening, please request the management to extend the date of the board meeting. Because what you would be doing is, very honestly, and I'm talking very openly about this, you will have a trail of entire documentation going back and forth after the date of the board meeting. You have still not completed the audit. You have still not reached the conclusions. Your confirmations are yet to come in. You may take 1 more month or 2 more months to prepare or finish up the audit or whatever. Your date of signing was, as a matter of example, 17th of August, 2021. You will sign off on that particular date, but you will sign off in the month of September. Let's say physically you are signing off on the 23rd of September with the date of 17th of August. Friends, this is the biggest mistake that you will be making. Do not accommodate the clients, because what you are doing is that you are receiving the information on the email, you are communicating with the client on the email, your team is working, they may be filling up the timesheets, and you are backdating the audit report 1 month before. This is completely wrong and unethical. And if at all the regulator would come to know, they will ask you the basis of conclusion on the 17th of August when you have the trail mail coming till the September. Be bold enough to go and tell the clients, sorry, I have decided that I will be signing off the audit report and closing everything on the date on which you are adopting the accounts. Before that, I'm not going to sign the audit report. Ek do bara bol denge, the client is going to understand, the client is going to listen to you, and they will agree with you. But you will be killing yourself if you will continue doing this, what you are doing in the past, if at all you are doing it in the past, and therefore stop doing this completely. That's my request to you. The name, the place on which you sign the audit report is a physical place. So for example, let's say if the financial statements, normally if my office is in Bombay, I'm just giving an example. And if I'm traveling to Nagpur for a day, and if the audit committee is on the same day, then somebody will have to send me the scanned copy of the financial statements. I will take a printout of that financial statements. The place of signing for me as an auditor is Nagpur. I will put that particular. The client may have signed in Bombay, doesn't matter. I have signed in Nagpur on the date. I will be once again doing a scanned copy of a financial statements which I have signed and communicating or sending it back to the client. That particular evidence has to be obtained and maintained by the auditor to demonstrate tomorrow in any regulatory proceeding that you have signed the financial statements on the 17th of August in Nagpur. Because you need to make sure that in the event that there is any inquiry, there is enough evidence of the fact. Otherwise, somebody will say, okay, we have found out that you are actually traveling to Nagpur that day. How did you sign the financial statements in Bombay if you have given that place a Bombay? So don't do all these things. Now you need to maintain, this is an electronic world, digital world. It's very, very easy to sign the financial statements in any corner of the world. You just need some limited infrastructure of a printer and a scanner. And if at all you can have that, the best thing is to do things in the right way, because the financial statements original copy can be demanded by the regulator if at all he would want to see those financial statements. And if at all there is any inconsistency out there, despite the fact that you would have done the best job, you would fail in your responsibilities as an auditor of not signing the financial statements on the day on which you are required to sign. So please be careful and very mindful of these particular matters. So this is all about the audit report and the audited financial statements. I would not want to go more detail, but sometimes, as I mentioned earlier to you, that many a times one audit opinion can cover two different set of financial statements, provided that there is no specific conflict between the two standards of auditing. Say, for example, you have your Indian GAAP financial statements and you have got your Ind AS financial statements. You can cover it under one opinion, provided that you have applied the same rigor of auditing both the financial statements and that there are no differences in the audit approach that you have carried out, as a result of which you can give one opinion. And therefore, this is a part of this particular section of the audit report. I would not want to dwell upon it because in India, normally this does not happen, but there is a provision under the standard to have two different financial reporting frameworks supported by one audit opinion. Now, this particular slide actually gives you the revised audit report in comparison with the earlier audit report. On the left-hand side, you see the format of the erstwhile audit report. On the right-hand side, you see the format of the current audit report. If you look at both, I think the biggest thing that has changed over here is, I would just put the pointer out here. You have your opinion. If you look at this particular opinion paragraph, it is at the outset because you have your title, then you have your subtitle that it is on the audit of the financial statements, and then you have your opinion. Whereas if you look at it over here, the auditor's opinion is coming much later. In the erstwhile format, it is coming much later. In the new format, it is coming at the beginning, and then it follows with the basis for opinion. And then if at all there is any emphasis that you require to carry out or require to report, then that emphasis is also here. And then you have your assessment of material uncertainty, ongoing concern, etc. And then of course, if at all it's a listed company or a company where key audit matters are applicable, then you have your key audit matters coming up over here. and then. So there is a big difference between the earlier format of the audit report and the current format of the audit report, which comes out very clearly in this comparative analysis. We are skipping off this section, so I'm not going to talk about it. Now I'm coming to modification, which is 7.0, because now we have about half an hour available, and I'll properly go through in terms of under what circumstances, what kind of an opinion you would be giving on the financial statements. And please hear me out very, very properly, because I'm going to make it very, very simple for you in terms of how you should be giving an audit opinion, which is not a clean audit opinion. Now, first of all, there are three different types of modifications. As I mentioned earlier, one is, of course, a qualified audit opinion. Other is an adverse opinion. And the third is a disclaimer of opinion. There are ideally two scenarios under which you will be giving such an opinion. One scenario is when you have all the information available and you believe that there is a material misstatement in the financial statements. Means that you have provided everything and you have come to a very, very clear conclusion that the financial statements are not free of material misstatements, which means that there is an error or there is an omission. And you have the impact of that also. Okay, because of certain errors and omissions, the profits are overstated, the provisions are understated, and therefore this needs to be corrected. That is one aspect. Second aspect would be that you do not have enough proper documentary and other evidence and information. And therefore, it will be difficult for you to give a clean opinion. Now, under the second aspect, when you do not have sufficient information, but you believe that the impact is material, but is not pervasive. And when I talk about pervasive, means it can not vitiate the entire financial reporting, but it is something which is undeterminable, unimaginable, and therefore you would not even be able to assess what is the impact on the financial reporting. Then that particular opinion which you will be having will be a different kind of an opinion. So we will talk about that later. So one is that you have all the information. Other is that you do not have enough information. And when you do not have information, you still believe that the impact is material, but not pervasive, which means that it can be justifiable that it may not be, it is material, but it is not pervasive. And the second element here could be that the impact can be material and can be pervasive, which means that the reported profits can turn into a loss, the loss can turn into a profit. You have no understanding about anything. And at that point of time, you may not be in a position to give an opinion. You are completely helpless. You do not know what kind of an opinion you are given. And therefore, at that point of time, you would generally go with a disclaimer of opinion, which means that you are not giving an opinion. And I think that is the second thing that you need to take into consideration. So we'll talk a little bit more about it, and we have a complete understanding on this. So as I mentioned earlier, one is a modified opinion, which is basically your opinion where you are making changes, or the company will be required to make changes for the company not to carry an audit opinion, which is a qualified opinion. I have defined the word pervasive. Look at this particular definition of a pervasive. This is very, very important for you to understand, because kabhi-kabhi kya hota hai ki you will not, I mean, for example, during the time of COVID, you may not be in a position to get all the information easily. You may be operating offline. You may be operating in a very different environment. And therefore, you need to be very, very sure that whatever information you could not get and whatever procedures you could not follow under the normal audit procedures, are there possibilities to carry out alternate audit procedures? If you have carried out alternate audit procedures to gain the same level of assurance, which is a reasonable assurance, higher level of assurance, and you believe that by carrying out all the alternate procedures, you have enough comfort, then there is no problem. But if at all for any reason, I'm just giving an example, that if the company has not verified the inventory is a significant component of the financial statements. You have not conducted any kind of an exercise of observing the physical verification of inventory. You could not depute anybody else to do that particular verification. And you do not know to what extent the inventory would have moved during this particular period, because right now you are sitting in the month of August. Management has not done the verification, auditor has not done the verification. Very difficult for you to come across this particular situation where you would not know कि आपको कहीं पे disclaimer देना है या whether you want to give a qualified opinion. Generally, the client will say, ठीक है, आप qualification लगा दो कि हम लोग ने inventory verification नहीं किया है, valuation तो हमने किया है, but that valuation may not hold good because first of all, you are not sure about the physical quantities of the inventory. And therefore, this can lead to a material misstatement in the financial statements. You do not have enough information to conclude on the inventory by carrying out alternate procedures. Here, the impact is material. And here, you have to decide as to whether it is pervasive. Matlab, can it distort the entire financial reporting? It may distort the entire financial reporting. That is a judgment that you need to take. So if it is material and if it is pervasive, then you will have to disclaim the opinion on account of this particular exercise not being done. But suppose if at all you come to a conclusion, basis some alternate procedures, basis some subsequent verification, if you can go back and reconcile the inventory records on 31st of March with the current inventory records. So let's take it today, you go and actually verify inventory. Now you have the verification done. The client has done the verification. You have observed the verification. You have certain quantities which you have actually seen and you are fine with that. Now you work backwards to come to the inventory verification, to come to the inventory quantity on 31st of March. You are satisfied with the reconciliation. If that particular inventory is very close to or equal to the inventory in the books of account on 31st of March, you have some conclusion. You may still want to qualify the accounts because you could not carry out normal audit procedures. But you know that the impact may be material, but may not be pervasive. And therefore, you may come to a conclusion that you may want to give a qualified opinion on this particular matter. Or you may come to a conclusion by carrying out appropriate audit procedures that the inventory verification, which is done now, is reconciling with the records on the 31st of March. And therefore, you have every reason to believe that things are fine. And therefore, you may just not want to give any kind of a modification in the audit report. That is a matter of your professional judgment, provided that you have got sufficient, appropriate, and adequate audit evidence to be sure what is the inventory on 31st of March. But the management should also be in a position to demonstrate the work that they have done to conclude the inventory on 31st of March. And this is something that is something that you will have to take into consideration. So when we talk about modified opinion, we talk about three different kinds of opinion. Qualified opinion. May I request to keep it on the mute, please? Somebody's. Thank you. So when you, under what circumstances can you give a qualified opinion? Very simple. You have all the audit evidence, but after having all the audit evidence, you believe that the impact of the misstatements in the financial report or in the financial statements, the impact of the misstatements is material but not pervasive. The company does not want to make adjustments on account of the misstatements, and therefore, if the impact is material, then you will be giving a qualified opinion, which is subject to or except for the effects, what we say. When would you give an adverse opinion? It's a complete ulta case. You have all the information available with you. The company has provided all the information. You have absolutely very clear that whatever audit evidence you require, you have everything with you. And now you believe as an auditor that there are misstatements. And those misstatements are not only material in nature, but they are also pervasive, which means that they are completely distorting the financial reporting and the financial statements of the company. The impact is such that the impact can be significant. It can be completely whitewashing the financial reporting, and therefore no way the financial statements are demonstrating a true and fair view of the financial results of the company and the state of affairs on the 31st of March. You are very, very clear that these are completely misstated. The financial statements are totally misstated. And therefore, under such circumstances, you will give an adverse opinion which says very, very clearly that the financial statements do not give a true and fair. Now, this is a very, very dangerous opinion. The auditor has got various options. There are different circumstances for a listed company and different circumstances for an unlisted company. But there are certain options that you have as an auditor, that you can resign from the audit, or you can actually communicate to those charged with governance, get those particular misstatements corrected. And if at all those misstatements are not corrected, either you give an adverse opinion and come out of it, or you can resign if the company is not wanting that adverse opinion from you. But friends, be very, very clear. And again, it's a word of advice that I have for you. In the resignation letter, you be very, very clear that you have resigned on account of the fact that you believe that the financial statements which are provided to you had material misstatements, and having communicated to those charged with governance, there is a disconnect, and therefore you had to resign as an auditor. The incoming auditor should know very clearly that you have resigned on account of such circumstances, because the regulators will confirm back with you. It has been observed that when you resign, many a times you get the letter from the institute, you get the letter from the ROC, you get the letter from SEBI in the case of a listed company as to why did you resign. And if at all you have resigned under such circumstances on account of the fact that you could not sign an opinion, you have to make it very clear, because otherwise you will be failing in your professional ethics of not communicating the reason to the incoming auditor, and he may not be in a position to determine such extent of misstatement, and you will never know what kind of a report he would be issuing. And therefore, you need to be very, very clear on that particular front. Do not ever give any other reason while you are resigning. You have to give the reason which is absolutely apt and absolutely correct for the incoming auditor to be aware that you have resigned under the circumstances for this particular reason. And of course, finally, disclaimer of opinion, I have made it very clear that when you do not have sufficient and appropriate audit evidence, and you believe that the impact of the material misstatements or the impact of the misstatements is material and pervasive, which is completely whitewashing the financial statements, you need to give a disclaimer, which means that you cannot opine on the financial statements. And therefore, this has to be also very, very clear. I'm just coming to the process that you have. So when you discuss with the management that there are material misstatements, it can be in a qualification. The management agrees. You determine the impact of the qualification. You put a para on the qualification. Your opinion should say that you have a qualified opinion. Your basis for opinion should also give that particular impact. And finally, you sign off a qualified opinion. But before doing that, as a matter of courtesy, if it is a listed company, you need to communicate to those charged with governance, which means that you need to communicate with the audit committee. Normally, make it a point for a listed company, you should have a closing meeting with the CFO and the CEO or the managing director. If required, whenever there is a qualified opinion, you should request the management to have a pre-audit committee meeting with the audit committee chairman. And you should communicate to the audit committee chairman that this is one particular matter where I actually requested the management to take adjustments in the financial statements. They have not done that. And as a result of which, I'm qualifying the audit opinion. Because then in the audit committee, you will not be questioned many, many things. Second, whenever there is a probability of an adverse opinion, which means that you have all the information and the material and the financial statements are not reflecting a true and fair view on account of the fact that the impact of the misstatement is material and pervasive, both. Then again, you need to communicate to those charged with governance that I'm sorry, your financial statements are completely wrong. They do not give a true and fair view. I would like to resign if you would not be willing to take an adverse opinion. Generally, do not shirk away from giving an adverse opinion, because It is your responsibility as an auditor to go ahead with the audit and give an adverse opinion if the client is not accepting your request to get the financial statements corrected. But where there is a pressure not to do that, you have all the right to resign. But after resignation, please make sure that it is communicated in the most appropriate manner, very clearly and very candidly to the incoming auditor as to why you have resigned. Nobody is going to save you in the event that you are going to put something wrong and it is surfaced in front of the regulator that you have hidden the facts of the case. So that is again your duty. And finally, if it is a disclaimer of an opinion, again the same thing. You need to communicate to those charged with governance. Such discussions have to happen with the CFO, with the MD, with the audit committee chair, with the audit committee very, very, very clearly, so that there is no ambiguity in terms of your understanding of the misstatement and the management and those charged with governance understanding of the financial misstatement. In the interest of time, I just wanted to give you this particular perspective about, look at this particular chart. I would like to talk about it on, I have spoken about it on these matters only. Under what circumstances you give a qualified opinion, under what circumstances you give an adverse opinion, and under what circumstances you give a disclaimer of opinion. So once again, I'll just take a minute over here. You are sure that your financial statements are materially misstated. You are sure. So I'm talking about the horizontal option. Your financial statements are materially misstated. You are sure. But you know that the impact is not pervasive. Very clear. You know the extent of damage. You give a qualified opinion. But where you know that the impact is material and pervasive, you know for sure that it can distort. That means it's not giving a true and fair view. You need to give an adverse opinion. Now coming to the second one, horizontally, you do not have sufficient information, but you believe that it is material and not pervasive. Yes, you will continue giving a qualified opinion. But when you do not have sufficient information and the misstatement can be material and pervasive, then you are required to give a disclaimer of opinion. It is important for you to spend maybe whenever you have the time to just go through this particular matrix, and you will be extremely clear about the circumstances in which you would be issuing an appropriate opinion. Do not mix up this, because the moment you will mix up this, and if at all you get carried away by the submissions of the management, and if at all there is any pressure on you to give an opinion which is a little diluted opinion, you have failed in your professional duties and in your professional responsibilities. And therefore, one should not do such things just because that you're coming under any kind of a pressure from the management. Now we come to the last portion, because we have only 10 minutes, and that is, of course, your emphasis of matter. Now, friends, I remember many, many, many years ago, before this particular standard came in, auditors were putting anything and everything in the audit report. Certain things which were supposed to be qualifications in nature were diluted to become emphasis of matter. We did not have the word emphasis of matter, but many a times in those days, auditors used to put the words, we invite your kind attention to this particular matter, and they will dilute. It is not the case. Emphasis of matter need to be given under circumstances where those circumstances would never lead to a modification in the audit report of any nature, whether it is a qualification or whether it is an adverse opinion or whether it is a disclaimer of opinion. You can never convert a modification into an emphasis of matter. An emphasis of matter is completely different. It is something which is not misstating the financial statements, but it is something that the reader of the financial statements should be aware as a very, very important matter, which the auditor also has emphasized the importance and the significance of the matter. And therefore, the reader of the financial statements takes a separate note of that particular matter. It does not reveal any misstatement, but it reveals the fact that the matter is a significant matter which needs to be taken into consideration. And therefore, this particular matter needs to be emphasized by the auditor in the audit report. And therefore, under what circumstances you normally report this matter, as I mentioned earlier, which is fundamental to the user's understanding of the financial statement and relevant to the understanding of the users in terms of the responsibilities of the auditors, that because the auditor has got certain responsibilities, the auditor also believes that in order to exercise the right responsibility, the auditor wants to emphasize on that particular matter. And therefore, this particular matter is called as an emphasis of matter. How would you report this particular matter? There is a separate section which comes with the heading called emphasis of matter. You also need to make a very clear reference. So in your audit report where you are emphasizing, you need to make a reference of that particular matter which is forming part of the note. Normally, emphasis of matter is a small paragraph in the audit report which you normally would highlight as to what that matter is. But you are not going to be reproducing the entire matter, which is otherwise given in the notes to accounts. So the management has made a disclosure on the, in the notes to accounts of what that particular matter is. And you would want to emphasize that matter by giving such information. Finally, when you make an emphasis of matter, and this is something which goes very well with the clients, my understanding and my experience is that, because the moment I believe that we need to emphasize, we tell our clients very clearly that this is something which will have to be emphasized, but there is also a particular line which comes below that particular note saying very clearly that the auditor's opinion is not modified. So the client is a little appreciative of the fact that, okay, fine, you are putting that particular line, but of course, I'm not putting that particular line. It is a requirement of the standard which says very clearly that the auditor's opinion is not modified in respect of this particular matter which is being emphasized. So do not forget to put that particular line, please. It is important for you to disclose that particular line so that the readers of the financial statements know that it is not a modification or a qualification in nature. Now, under what circumstances you believe that certain matters need to be emphasized? If at all there is any uncertainty looming around the company and you do not know the future outcome of any particular exceptional item or any item of litigation. For example, there is a court case going on. It can tantamount to a conclusion in the future where the impact on the company can be very significant. It's an uncertain event at this point of time. You know that the case is weak where the company is concerned and it could result into a potential impact through a huge liability coming on the company. Then, of course, you need to report that. Suppose if at all there is any early application of an accounting standard. And because of the early application of that accounting standard, it has a pervasive impact on the financial statements. So that accounting standard is not applicable now. It is applicable in the future. It could be just, I'm giving an example, fair value change or 109. As a result of which, there can be a significant impact on the financial statements because you are now going to be valuing your financial instruments on a fair value basis. And it is a pervasive effect on the financial statements. Then you would want to emphasize that particular fact. Or if at all there is any major catastrophe which has happened, and as a result of which, it has a significant impact on the entity's financial position. Because of a major fire or because of a major catastrophe, the company has suffered a significant loss. It is definitely something that you may want to emphasize upon. So there will be a note in the financial statements, and as a result of that particular note, the auditor may wish to emphasize this particular matter in the audit report. And then there are certain other matters. So we spoke about emphasis of matter, and then there are certain other matters that are required to be reported in the audit report. They are not emphasized, but they are just matters to be reported, drawing the user's attention to the auditor's report on matters which are related to certain other things which are not disclosed in the financial statements. For example, there are certain matters. Say, for example, financial statements of the earlier period have been audited by the other auditors. If at all you are a new incoming auditor, then that particular matter is another matter that you need to report into. Or there are certain matters whereby you are not covering as a part of your scope the audit of certain subsidiaries, etc. And therefore, they become part of the other matters because the management does not believe, and rightly so, the management does not believe that it is their responsibility to report such matters in the notes to accounts. And therefore, it is a responsibility of the auditor that those matters will be reported by the auditor himself in the audit report. Okay. Now, the auditor shall include this particular other matter in the auditor's report, provided that it is not prohibited by law or regulation or other standards to be reported. And therefore, you need to be very, very clear that whatever is prohibited by law or regulation, you may not want to report. That's okay. Secondly, 701, which is basically my key audit matters. It is very, very clearly clarified over here in the standard that never mix up the two standards. If at all there is a key audit matter to be reported under the key audit matter section of the audit report, you have to report appropriately in that particular section. You cannot report it elsewhere to diminish the importance of that particular matter. And therefore, whatever has to be reported needs to be reported as a key audit matter. You report as a key audit matter. So this is what you generally report under the other matters as such. This is a very detailed presentation. I think the fact that very clearly one difference remains between the key audit matter, between the emphasis of the matter, and between another matter. Maybe I'll just take a minute so that you are very, very clear. Some of you may not have gone through the rigor of a key audit matter in the event that you may not be involved in the audit of a listed company. But key audit matters are some of the important matters which you want to disclose in the audit report because of the significance of such matters. Say, for example, certain areas like revenue recognition, IT design, IT testing, internal control testing, or could be in relation to provisions and contingencies, where you spend a good amount of time of your audit and where you have carried out adequate audit procedures, and which, according to you, has not resulted into any misstatement in the financial statements. They become your key audit matters and you report separately in the key audit matter. When it comes to emphasis of matters, we have discussed about the circumstances under which certain matters need to be emphasized. And therefore, there will be a detailed note in the notes to accounts. And you emphasize in the audit report by drawing a reference to that particular note and by making it very clear to the users of the financial statements that this is something that you have emphasized on. And then there are other matters which may not be presented in the financial statements or in the notes to accounts, but you believe as an auditor, it is important for the users to know about certain things that you did not audit the financial statements of the previous years, or you have not carried out the audits of certain subsidiaries and associates and you have relied upon some of the reports, or you had oversight on such reports, etc. So those things form part of my other report, other matters. And therefore, please be very, very clear that under what circumstances, which matters need to be reported, where in the audit report. But I repeat again, as I mentioned earlier also, do not dilute the importance of a particular matter which needs to be modified in the audit report. Whether it is a qualification, whether it is a disclaimer, or whether it is an adverse opinion, those should not become a key audit matter, or those should not become an emphasis of matter, or those should not become other matters. If those things dilute to that, then you have failed in your professional responsibilities and your professional judgment to report the right things. With this, I would conclude the presentation. Thank you very much for the opportunity, and happy to take any questions if you have, please.
Thank you so much, Khushroo sir, for a wonderful deliberation. Definitely, this is the need of an hour, and a lot of the professionals have some queries regarding the same. There are few queries in the chat box, sir. I will read it out for you. At what point of time will the financial statements need to be prepared for more than the previous year? Means the third set of revised or adjusted financial needs to be drawn up for assessing the impact in financial notes, cash flows, etc. Could I repeat the question?
Yes, please.
At what point of time will the financial statements needs to be prepared for more than the previous year? Means the third set of revised or adjusted financial needs to be drawn up for assessing the impact in financial notes, cash flow, etc.
So when we are actually, I mean, for example, when we are transitioning into Ind AS at that point of time, normally you have three balance sheets because you have the opening balance sheet. So let's say that you are preparing the financial, let's say that it is applicable. Let's say a particular company changes a financial reporting framework from 1st of April 2020 as a matter of example. Now, your balance sheet as of 1st April 2019, your balance sheet as of 31st March 2020, and your balance sheet as of 31st March 2020. These are the three things that you need to prepare under Ind AS. So the opening impact will come in the opening balance sheet of the previous period, because you are comparing the current period with the previous period, and therefore all your adjustments will go into your retained earnings at the beginning of the earlier preceding period. And therefore, when you do that particular comparatives, you have your two P&L accounts and you've got three balance sheets. So you normally go back into the respective opening balances of the previous period to give that particular impact of the transition.
Sir, very recently also when we had one of the seminars, Mr. Yagnesh Desai had said that it could be because of some fraud or something related material misstatements, and then the impact was assessed 3 years or 4 years before, and then the impact was known only during the current financial period. So that would also result in preparation of the financials so that it can be corrected from that point of time, and the impact of which can be assessed in this given period that requires to be reported or something like that. That point actually I'm not able to, was not very clear about it.
No, so in case, yeah, so very, okay. So now the question is very clear that in the event that a particular fraud is discovered in the current period,
yes,
it relates to the earlier period. And if your financial statements are prepared under pure Indian GAAP per se and not under Ind AS, then this is basically an item to be reported as a prior period item. And if it is a fraud, then your auditor's responsibilities for the fraud. In the event that this is basically prepared under Ind AS, if the financial statements are prepared under Ind AS, and if that particular fraud is material, then you need to restate the previous year's financial statements. And when you restate the previous year's financial statements, your restatement has to happen in that particular relevant year and carry forward that particular impact of restatements.
The classic example would be the Crompton Greaves Power Limited, which about 15 days back, it was already widely discussed, and then all the auditors and all, like the earlier auditors and the due to the recent changes and all, they all have been charged over there that for not disclosing, because SBI themselves reported the bad loans very late, after 4 years or 5 years. So would that be applicable? Such a classic example would be applicable in this given scenario of the question that I'm asking you.
That's right. So when the auditor will actually finalize the audit in the coming subsequent year, he will have to take cognizance of such things by ensuring that these financial statements are restated.
Just a small thing, last question is that about that, the partner who had actually signed it earlier has already passed away due to some unfortunate circumstances, but ICAI has decided to take action against him. What can be done when the person is not alive at all?
I would not want to comment on this, sorry.
Thank you.
I think I'll reply. Good morning, sir. All of you there. Yes. I'll reply this. First of all, as per the current ICAI Act, CA Act, ICAI can act only against a person and not against a firm. Such a provision is there only with NAFRA, and that such provision is being asked as an amendment to CA Act, which will come. So in any case, if the person is no more, as of date, I mean, Amarjit Chopra sir is in the disciplinary. He is there with us in the panel. So we can always ask him as to whether disciplinary can be done against firm in such cases when the person is dead. I think no, not in the current circumstances. Such provisions have been asked as a change in CAC, but as of date, I don't think that is possible. Amarjit sir, can you say something on this?
Thank you very much, sir, for the kind answers given over there.
Yes, sir, I think he has to unmute. Please wait for a minute. Amarjit sir will unmute. He is in disciplinary, so he will answer. Reply, sir. Good morning, sir. Amarjit sir, if you unmute and reply, it will be better.
Amarjit sir, I think it is muted, sir. Sir, that audio is muted, sir. साकेत जी, पास प्रेसिडेंट सर का अनम्यूट कर सकते हैं.
हो गया.
The point that I'm trying to make out is that in the institute, in the Chartered Accountants Act, there is no provision to go against a dead person. There is no way that it can happen. So if at all a case is being filed against a person who is already dead, and if he was considered to be the member answerable to charge by the firm, in that case, the case becomes infructuous. So today's scenario is this. What will NAFRA do? I don't want to comment upon that right now. I think only the times will tell, because any firm will be able to take the advantage of this particular situation, that if a person who has actually signed the balance sheet, who supervised the entire audit process, if he is no more, it will be very difficult to proceed against the other partners of the firm or against the firm. I don't think it will be very easy for any of the authorities to do it, even in the times to come. But so far as this institute is concerned, our disciplinary mechanism is concerned, we cannot proceed against the firm. We can only proceed against a member. And if a member is dead, that's the end of the matter.
Thank you very much, sir, for the kind query which you have clearly explained to me. That's all from my end.
It is always wonderful when the panel discussion starts on a certain query. So we are feeling privileged. There are few more queries if the panelists permit me to ask. Any of the panelists and the speaker can.
I think Akshay, just wait. There is something to be done for the panel. Khushroo ji is extremely busy person, being in a very, very large firm. If he wants to be in the panel, I welcome him. But otherwise, we start the panel properly, then you ask any number of questions you like. That is what request is. Khushroo sir is extremely busy person. If you want to retain him for more time, you will be charged a few thousands per hour.
That's a good one, Mr. Joshi. So first of all,
I think
Shriniwas, in lighter ways,
Shriniwas, you have underestimated charges of Khushroo. I think it's a gross understatement.
Gross understatement.
Gross understatement.
वो rupees in thousands बोल रहे थे.
Basically, he was trying to tell in terms of dollars rather than in terms of. That's the position.
Yes, sir.
No, I wanted to say.
Amarjit sir, Khushroo has been extremely helpful to WRC and to the profession in every way. In every way he is possible. He has been a part of several groups, several publications, several seminars, conferences, and he has been supportive. Thank you, Khushroo sir, for being very much supportive to all of us in the past. And he will continue to do it in future, I hope.
Mr. Joshi, thank you, and my greetings to Mr. Chopra, yourself, and Aniket. Nice to see you all, and wish you all the best for your session. Thank you so much.
Yeah,
thank you to Nagpur branch for inviting me for this. Thank you so much.
Thank you, sir. Thanks a lot.
Thank you. I'll take your leave, sir.
Thank you so much.
Thank you.
Thank you, Khushroo.
Friends, no doubt the panel discussion has started, but before that, it is our privilege to briefly introduce the panelists today. I know all the three stalwarts need no introduction, but for the sake of the participants, we have Shriniwas Joshi sir as a moderator of today's panel discussion. Sir is a partner in CVK and Associates, Chartered Accountants in practice over the past 40 years. Sir is Chartered Accountant and Company Secretary since 1980. He got elected in the Central Council for the period 1316 and 1922. He was chairman of WIRC of ICAI for the year 1112. Sir was the chairman of Financial Reporting Review Board for the year 1920, chairman of Professional Development Committee 2021, chairman of Corporate Laws and Corporate Governance Committee 2122, convener for UDIN Directorate, vice chairman, convener and deputy convener of various committees at ICAI, and currently he is a member of 29 committees, 3 directorates for the year 21-22. Sir is also on the committee of SAFA, that is South Asian Federation of Accountants. He is also a member of groups of various committees as well. We welcome Shriniwas sir on the forum of Nagpur branch. Our next panelist, Honorable Past President of ICAI, Amarjit Chopra sir. Sir is qualified as a CA in 1975 and had a privilege to be the chairman of NIRC for the year 88-89. Sir was also elected as a past president of ICAI for the year 2010-11. Sir was nominated by the central government as chairman, National Advisory Committee on Accounting Standards for the period of 4 years from 2014 to 18, and as chairman of NSCS NACAS was responsible for implementing Ind AS in India. He has been nominated by government as a part-time member of National Financial Reporting Authority, that is NAFRA. He has privilege of being the chairman of various committees, especially the CARO in 2016. He was the chairman of various committees of corporate laws as well. Amarjit sir, we welcome you on the forum of Nagpur branch. We have another dynamic Central Council member with us, Aniket Talati sir. Sir, as a financial execution with broad experience in all aspects of accounting, auditing, taxation, and financial management. Sir is a partner in Talati and Talati LLP, Chartered Accountants. He is a director of the Institute of Chartered Accountants of India, Accounting Research Foundation, ICAI. He articled from Lowlord and Lewis audit firm, that is PricewaterhouseCoopers. Sir got graduated from University of Mumbai and Chartered Accountant since 2009. We welcome Aniket sir on the forum of Nagpur branch. I request you, Shriniwas sir, to kindly take forward the session. Over to you.
You want to introduce Ashutosh Joshi sir or not?
Ashutosh Joshi, sir.
I think he's the. This is a three choice of. When I was
Local person.
talking to Saket sir, I thought there is at least one local person who is available to you all the time in audit. And why not Amarjit Chopra and Aniket was my choice, but I thought then Saket said Ashutosh Joshi is the best person to attend. So
Ashutosh,
we have invited him as a yes sir. Please introduce him.
Very dear to me and near to me. So Ashutosh sir is a senior partner of PG Joshi and Company, a CA firm since 67 years in profession. As a partner in charge, he handled statutory audit assignments of listed companies, large PSU, banks, and banks as a central statutory auditor. Financial management consultant with rich experience in urban finance, personal taxation, compliance and assurance, and financial management system designing. He has a special interest consulting in urban finance. Some of the projects he worked with are the World Bank, CRISIL and Deloitte, ICF, GHK, UK, IDFC Foundation, New Delhi, and again CRISIL. He has designing of financial management system and MIS for manufacturing companies. He has a special interest in banking system and processing. He is expertise in fraud investigation and related matters. Ashutosh sir, we welcome you on the forum of Nagpur branch. I request Shriniwas sir to kindly take forward the session.
Yes. Good morning to all. Thank you, Saket, for giving us the opportunity, and Akshay to introduce all of us. Good morning to our past president and guide and mentor to almost all here in the council as well as outside the council, Mr. Amarjit Chopra sir, C. Amarjit Chopra sir. Aniket Talati, my junior most council member, but my very dear friend. And that's why I suggest, considering his extraordinary knowledge in various aspects which are on display in council and in groups and in committees, I thought he will be the right person to be on this panel. Ashutosh Joshi sir, I know for a long time, and I thought again his experience is good for all of us to listen to all of them. Friends, coming to this particular question answer session, before that I felt that there is a background to be made to all of this, and I think let us start with talking about auditing standards as a subject. Friends, we feel that if I know auditing standards or if I apply auditing standards, I will give quality in the work that I am doing in auditing. Is it enough? All of us are doing this for ages. Now, Chopra sir has been extremely, vocal on several aspects of this, but I would feel that he has been saying whether there is a quality within us or why there is then the expectation gap. because on one side, the current NAFRA paper says that institute is actually trying to lower the standards either or lower the expectation of the population in application of auditing standard rather than filling that expectation gap. Now, such type of comment coming from the regulators, such type of feeling in the society that we are not giving the quality is because we have stated in the reply also to NAFRA that there is a misunderstanding on the role of auditor, which of course as Amarjit Chopra sir will explain to us that what is the expectation gap. They feel that when a person signs the audit report, a chartered accountant signs the audit report, there is no fraud. There cannot be any fraud in an account signed by chartered accountant, where the institute says that if there are indications, and SA 240 talks about it, if there are indications of the fraud, then naturally he has to find the fraud. In fact, under section 143, subsection 12 of Companies Act says even a suspected fraud needs to be reported, not even the actual fraud that a person has found. So, but there is a huge issue there. Another, I think, mistake we make in doing the work, and therefore we are not able to probably enhance the quality, is we work as preparers of account, especially small and medium firms, rather than the persons who review the accounts. So moment we go into the preparation, there are several errors in the note, the way we write the notes, way we write the accounting policies, and way we audit it. Because once the maker-checker concept is lost, I think the quality is an issue. Institute on its has done a lot of things to improve quality or to maintain quality. Not only AASB and AASB gives us standards, but if you see FRRB, where currently Aniket is the chairman for the second consecutive year, I was the chairman the first year. Financial Reporting Review Board has been giving so much advice in all matters. To the profession. He is doing extraordinary task in giving these advisories in all the cases to us. QRB is another committee of the institute which give advice to us on improving the quality. Now, of course, from 2 years back, Tax Audit Quality Review Board has been formed. They are giving us advice on improving quality in tax audits, and now they will start even on GST audits. In addition to that, previous immediate past president has formed a center called Center for Audit Quality in Jaipur. Now that center, when council has formed, we have now issued, they have first of all a course on audit quality, which covers all the major auditing standard, as well as lot of aspects relating to technology in audit. And also AQMM, also Center for Audit Quality has given us the AQMM, Audit Quality Maturity Model. If followed by the firm, definitely will improve quality substantially. I think right from the time Amarjit sir was the president, DCMM, that is Digital Competency Maturity Model, was started 1.0. Now it's 2.0, which is even adopted by Europe from ICAI. I think if we can get into those kind of models and see whether we can improve, I think we will make wonders into doing the work. Of course, there are several other things required, which we talk in auditing standard about the professional skepticism, fearlessness in reporting without feeling that we will be, we'll lose the work, or we should have, it is said that we should have uncompromising attitude towards wrongdoings or errors. But in practice, we feel that whether we are conscious to the oath that we have taken as the auditors and as chartered accountants, and whether we really draft our report, whether we are making any effort to draft the report, or SA 700, which we heard, the illustrative format, we just copy and do it. Are we really clear about what is wrong? If we are clear about what is wrong, then only we can draft the report. And therefore, I think our quality, there is something missing in the quality all the time. I think before this was just an introduction to this subject. I'll ask each of the panelists to first speak few words on one subject each, which I have conveyed to them, that what I will expect them. So I start with with Joshi sir. I am asking Joshi sir, what is the relevance of auditing standard to enhance the audit quality? This is a very, very basic question. So we start with basics, saying that what is the relevance of auditing standard to enhance the audit quality? Joshi sir, over to you. Can unmute and start.
Good morning. Can you hear me?
Yeah.
Yes, sir.
Thank you. So to begin with, I'm extremely happy this morning because I am in a company with the luminaries in the profession. Thank you, Shriniwas, for suggesting to Saket that I can be a part of this panel. I'm so honored to be amongst Amarjit ji and Aniket ji. They are luminaries in the profession and people look up to you for various guidance. Thank you, Saket and the Nagpur team, Jite, Akshay, and everyone for inviting me and bringing me on this panel. Now, without wasting much of time, I have some notes with me. I'm going to refer to my notes when I'm speaking to you. So, how the auditing standards are helpful in quality of the audit. If we go through the accounting standards, right from the beginning 200 onwards, 210 till the last, I think these auditing standards have been prepared and mandated by the institute to help us auditors, so that in case there is any issue regarding the way we conducted our audit, the way the audit was planned, the way it was reported, no aspiration should be casted on us. And if that is done, we should be in a position to defend ourselves by the records and the documentation and our observations that we have with us. So audit, basically it's an independent examination of financial information of an entity, whether it is a profit making or no profit making. Basically, it is done to express our opinion on the truth and fairness of the accounts. So the basic objective is to express an opinion. We begin with SA 210, where the terms of engagement, they are decided. The auditor, he sends that engagement letter and accepts what is expected of him, and the areas that he's going to cover, the scope that he's going to cover. If there are limitations, he needs to identify as he proceeds. SA 220 requires the auditor to ensure that he carries out the audit in line with the standards on auditing. We must have a policy for quality control in the firm. Now, I wish to mention here that those of the firms who have been exposed to peer review, they would realize this, that all the things about standards on auditing that we are talking about is a part of the assessment that the peer reviewer makes when he confirms that you are peer review compliant. And it contains a huge questionnaire, a lot of documentation that is required. If we go through that, I think everyone will understand what the standards on auditing are all about and what we are required to do in order to safeguard ourselves from any external threat that we may have while we have audited the accounts of the company. SA 220 also requires that we should have our team, which is having enough skill and experience to carry out the work, so that they understand the environment of the entity and carry out the audit accordingly. SA 240 talks about auditors' responsibility to fraud and how he responds to it and reports. So the fraud could be of two types, where the fraudulent financial reporting could be there, or it could be an asset which was misappropriated and then later on you find out and that is reported. So primary responsibility of preventing the fraud lies with the management of the company. Naturally, auditor will go through what controls does the management have on their policy of prevention of fraud. And based on that, and then his own assessment, SA 315, where the risk is assessed, he will find out whether which are the areas which are prone to fraud. I'd like to give you an example of one assignment that we did for a bank, where the bank management did suspect that there was something going wrong, and they asked us to look into it. So we were introduced there as concurrent auditors to begin with, and not to investigate the fraud to begin with. But as we planned our audit and found out the areas of risk, we had our audit procedures which were substantive in nature, and went into the depths of the reporting that was happening to the management. And later on found out that there was a misappropriation of funds to the extent of 75 crores. Now, how this was happening over there was the CEO of the bank. It was a cooperative bank basically. So the CEO of the bank was involved in the whole process. We found out that the areas which he was directly controlling, they were not subjected to any kind of concurrent audit, external concurrent audit for the past 10 years. Even the RBI had come in, they gone through the various reports, and they were not able to identify or say anything about the frauds that were taking place. So we found out two areas where this was happening. One was the main branch where the advances major were there. That was not subjected to external internal audit. The internal team used to carry that out for a long time. And second was the reconciliation department in the bank, where the reconciliations were being checked by the internal team and no external person was ever doing that. So considering, after having identified the areas, we went into the depths and then found out that they were playing around with the bills that were discounted and rolling them instead of realizing them, and rolling through the branch reconciliation accounts. And that amount was very substantial. So over a period of time, they had been doing this and getting the bills discounted. Some of the branch managers who came to know that certain entries are appearing in their reconciliation and they have been there for a long time, they raised some questions. When they raised questions, that entry was removed from that branch and again put up into a different branch with the broken up figures. Also in the branch, when we realized that, we asked them that, we want all the data in Excel format. So they were very reluctant to give the advances related data. And after we insisted and we got the data, we found out that the details of advances, which was running into several pages, maybe close to 70-80 pages, the entire details. The total of that those advances in that statement was not matching, and there was a difference of 18 crores. So we inquired and asked them. So initially they said, no, it must be some reporting software problem. But later on, we found out that they had manipulated the softwares in such a way that certain accounts which were fraudulently given as loans, they were not appearing in the list, but the totals were matching with the balance sheet. And this was possible when we extensively used our auditing and investigative tools, and the whole thing came out. So in short, what I just wanted to convey was, if the risk assessment is properly done, there is a good chance that if something bad is happening, you can always lay your hands around that, or at least try to find out, dig it more deeper to find that nothing bad has really happened. So that was about the fraud and the responsibilities that we have. If we are aware that there are certain areas where the frauds might have happened, or if we come across that, then we need to disclose that. We have to explain that clearly in the report, saying that what has happened. Then SA 260 talks about communication with the management. So basically, we have to make ourselves clear to the management as to what are the responsibilities of the management and what are our responsibilities. What is it that we are going to do as auditors, and what is expected from the management basically keeping accounts and maintenance of accounts, doing accounting estimates and the accounting policy and related matters. They are all the part of the management's work. We have to communicate this to them that this is their work and they have to convince us on certain things that about which they have taken decision as the management. One of the most important standards on auditing, I think, is 315, which talks about identifying and assessing the risk of material misstatement. This is a very important standard on auditing because, as I said about the fraud just now, if you are able to identify and apply the procedures where you assess the risk of material misstatement, it is very well possible for you to get to the roots of the exact problem and bring them out. I can give you a example of one of our entity where we audited, where it was a big group of educational institutions where the fees were collected on an online and an electronic platform. Basically, they had outsourced the collection of fees to a third party where the direct receipts of the revenues of the fees, they were collected either by way of credit card or direct transfer to the banks. And with a T+1 or 2, the money was deposited in the bank of the entity. So it was found out that regular reconciliations were not happening with the statements that were being forwarded by the entity and the amounts that were deposited in the bank. And since the reconciliations were not taking place, they were not in a position to understand whether the fees from all the students were properly accounted for and it has come or not. Again, these institutions, they have a policy of recording the revenues on a cash basis. So their balance sheet was not revealing anything about fees that were receivable. Later on, we found out that more than 45 lakhs of rupees was fees which was to be received and which was not received for the previous periods. So unless we have a very sound procedure for identifying such issues, these may not come up. And 45 lakhs for an educational institution is definitely a material amount which was not represented appropriately in their financial statements. So we have to engage in ourselves into the processes of the procedures by which we are able to identify and assess the risk and then accordingly change our plan, audit plan, and carry out the work to address the risk. SA 320 then talks about audit materiality. Materiality is basically, that is materiality for the user of the information, whether he can be influenced by taking a decision based on the financial statements that he get. So if he is can be influenced with that figure, it is a material figure for him as well as for the auditor and the entity. I think for statutory requirements, the materiality may not apply because something which is statutorily has to be done. It has to be done irrespective of whether the amount is very material or not material. We have carried out an audit of one entity which were into exploration of oil at the high seas, crude oil. And it was a basically very highly capital intensive industry where the balance sheet is very, very heavy as compared to the profit and loss that we see. Because a lot of money goes into building the asset for exploration. So there they had a policy where 50 crores was a threshold for prior period entries. If it was more than 50 crores, they did consider that as material and not otherwise. So the materiality may vary from entity to entity. For some people, 50, 100 crores may not be material, but for some, even 1 lakh rupee could be material. I think we need to understand this on a case-to-case basis based on what the business the entity is into. Then SA 330 now talks about the auditor's response to the assessed risk after having assessed the risk, how we respond. So as I said, we need to amend our strategy, amend our audit program to see that the risk gets covered properly. Here, what is important is, as a part of response, we must have audit skepticism. We have to see that there is enough skill in the team that can take care of those skills, the risk that has been identified. There has to be a close supervision from the auditors, the senior partners or the engagement partners side, and they have to monitor the areas of audit where the risk has been identified very closely. When we talk about SA 402, which talks about entities which use service organizations. So as I said, gave you an example of this educational institution, which they had outsourced their fees collection to an outside agency where the money was being collected and given to them. But there was an issue there. And since the reconciliations were not happening, there was a big gap in the revenue that was recorded. So in such cases, the auditors have to be very careful as to what that service organization is, how their accounts are audited, whether there are any adverse remarks or qualified opinions of their auditors regarding their processes, about the controls that they have. And these will help us in terms of understanding whether the service organization is really geared up to give that kind of service properly. Then SA 540 talks about auditing the estimates, accounting estimates, then fair value accounting estimates and related developments. So estimates is another gray area where a lot of caution is required. Basically, estimation would come into picture where there is no clarity or absolute accuracy about the figures that are being taken into the financial statements. We had one experience in the same company, as I told you, oil exploration, where one of the blocks where they were investing a lot, they identified the block first based on the reserves that were there for the crude oil. Later on, they understood that as they progressed, that the reserves were not sufficient for them to carry on the activity, and they decided to close it down. So the period when they started with the exploration and period when they decided to close down, so both had an impact on their financial statements, because then after that they had to make certain provisions. The provisions were based on certain technical assessment, and what kind of technical assessment that was done, a work of a third party external expert was brought in. So the auditor, we as auditor had to go through all these things and take a considered view as to what exactly the impact is appearing and coming on the financial statements of the entity.
Joshi sir,
Yeah.
I will request you to, wait for some time. I have several questions on different auditing standards, and Amarjit sir is there. So we will request some of the other panelists to speak first, and you can give expansion of your other thoughts in the questions.
Okay, sure.
But you have done extremely well in telling us that audit tools are absolutely necessary for us to be used. The risk assessment, which you said, was so much important to all of us, which we hardly do in most of the audit, which is important tool that we can use. You have talked on IT controls, how important they are and how we are not looking into it. You have talked on scope limitations given to internal audit and others, and you have given many practical examples. We would have loved to listen to you for hours, but this being a panel discussion, I'll request you to put your thoughts in the question that I have.
I understand.
Yes, sir. Thanks a lot.
Much.
I will request now our young member Aniket ji. There is always a thought in the mind. The client comes and says, bank wants to renew my limit or increase my limit, and they want the balance sheet. But you say we are already only at the end of April. How can I give? I have not audited. I don't have balance sheet. You don't have sufficient record completed. or you don't have, you say, but I made provisional balance sheet. We have done everything right. Can you just sign and give it to us? And many of us are under impression that we cannot do it, but we have to do it. The problem of cash 22 situation that I may lose client, etc. So whether some of us just stamp that paper and give it. Whether there is any auditing standard relating to helping us in doing this work, or this is completely banned, question number one. And related question is, sometimes we get prospective financial information, like we get 5-year balance sheets, etc. To us, and the party says that this is going as a supporting to my project report I am filing for new proposal, etc. Can you certify this? Now, both again, we feel that something prospective we can never certify. Are there any auditing standards which support us and allow us to do, or this is completely banned? Is the question. Aniket, over to Aniket.
Thank you, Joshi sir. I will get on the answer in just 1 minute. Before that, let me acknowledge and say how much of a privilege it is for me to be a panel member along with our honorable past president Amarjit Chopra sir. Sir, I have followed the journey of SAP to AAS and then SA. And let me share with all the participants who are present here today. I think Chopra sir has been at the helm of this entire journey. And I say this with my own personal experience, Chopra sir. Whenever, even during my articleship days, or when I qualified and there was an issue with relating to the auditing standards back then, now the standards on auditing, my father always used to mention there is only one person in our council who can give the right answer on that. And that was always Amarjit Chopra sir. So compliments to Joshi ji and Saket bhai for inviting the right person who can give us, the entire background on this topic. I must also at this juncture compliment and congratulate Joshi ji for organizing this under AASB. I think, dear participants, it's so easy. Let me honestly share with you, to be a council member and then keep a session on income tax, maybe on GST, say input tax credit, or taxation of partnership firms. And instead of 100 odd participants we have today, it would be 500, 700. But I think very important question that Joshi ji started the session with. What is the importance of audit standards? और मैं समझता हूँ साकेत जी, अगर हम और सब members audit standards या standards on auditing का importance सच में समझ ले, I think the situation will be reversed, because capital gain का session और गिरीश आहूजा सर आ रहे हैं. हम में से कितने लोगों को करोड़ों रुपए का कैपिटल गेन होता है मैं नहीं जानता. हम क्लाइंट के कैपिटल गेन के लिए 3 घंटा बैठ के सुनते हैं, बट जो ऑडिट रिपोर्ट हम खुद साइन करते हैं उसके स्टैंडर्ड्स के लिए हमें आधा घंटा भी लगता है. अरे यार, ये तो थियोरेटिकल है, बोरिंग है. सो आई मस्ट कॉम्प्लीमेंट बोथ ऑफ यू, इनफैक्ट साकेत जी एंड ऑफ कोर्स आवर लीडर विद दिस program, Joshi sir, for organizing this very important session, because whatever awareness can happen on standards on auditing, I think it's going to be hugely beneficial. So compliments Joshi sir for the exemplary leadership and courage of having this program, sir. Sir, 2 points that you very importantly raised, I will answer them. If I take the latter first, which is with regards to the provisional or the projected financial statements. Some of us know them as the CMI data. Some of us call it the prospective financial statements. Now, what typically happens, dear members, is that we all go to our Chartered Accountants Act. We look at the clause 3, the part 1 of the second schedule, which clearly says that member is guilty of professional misconduct if he engages in estimation of earnings contingent upon future transactions in a manner in which it leads to believe that he is vouching for the accuracy of the forecast. That is to say, as a chartered accountant in practice, I cannot say this will happen tomorrow, this will happen 1 year from now, and this will happen 5 years from now. So far, to the best of my knowledge, in the CA final course, we don't have astrology, we don't have astronomy, so we are not in a position to predict and certify what can happen in the future. And I think that is why the Act provides for this very specific clause with regards to what has to be done in terms of future financial information. Even if you look at companies, they are very clearly now laying out when they say there is forward-looking statements. So they clearly say these are forward-looking, you cannot guarantee them. But the beauty of our standards, Saket ji and everybody who's attending this session, I think our discussions generally end on standards and auditing. So we started very rightly what Ashutosh just mentioned, and probably we end at the SA 700 series, which the previous speaker spoke about. Those are the reporting standards. And we feel that our audit standards are over. In fact, before SAs, there is SQC, very important. I will not waste time on that. But after SAs, there are three very important sets of standards. The first being review standards. जो लोग यहाँ listed company करते हैं, they are aware we are giving limited reviews. We are using those SREs, that is the review standards. After that, there is a very important set of standards which are for assurance engagements. Assurance means I am giving assurance to a third party as a practicing chartered accountant that you can rely on this. I am not auditing it. Audit is a very high threshold. It means I'm giving an assurance, I'm issuing an opinion. A review is one step lower than audit, but it still gives moderate form of assurance. These assurance engagements are actually a step lower than audit. And there is a very important assurance engagement standard, which is known as SAE 3400. And what does this standard say? It talks about examination of prospective financial information. A chartered accountant, as it's given in the Chartered Accountants Act, cannot say this will happen in the future because we do not predict the future. What I can do though as a chartered accountant in practice is issue my report and issue that report as per SA 3400 and state that I have, for example, looked at the assumptions. Company 5 साल से existence में है, consistently 8% growth है. Management has assumed a 8% growth for the future years. It's a reasonable assumption. So you see the assumption, its reasonability. You verify the mathematical accuracy of how the projection is made. And my request to all the participants today, please only issue a report as per SA 3400. Don't venture and simply stamp and sign the CMI data because that would mislead. That would mean that you are vouching that ye hi future mein hoga. And then when the company is not able to repay its debt, the bank complains saying we relied on the auditor or the chartered accountant and he says this is going to be the future. We never predict the future. What we can do is we can examine them. Just how you would do it, for example, in a prospectus for a company going in IPO, this is a similar examination. So to answer the second question first, you may issue, but please always issue a report on it as per SAE 3400. And on the very important question that Joshi sir asked on provisional financial statements, काफी लोग क्या करते हैं सर, टैली में से बैलेंस शीट P&L निकालेंगे, ऊपर लिखते हैं unaudited provisional, and immediately we sign and stamp and we issue. My dear friends, it is not our job to put a true copy or a stamp on financial statements. As an auditor, as per the ambit of standards on auditing and the entire series, you are to issue an opinion on your financial statements. If I can just for a minute share my screen, and Saket, if you can confirm it is visible to all the participants.
Yes, sir.
Yeah, I've put up, the annual report of one of the most famous companies, Reliance Industries, and I would just like to take you to the bottom of the financial statement. Sir, हम जब भी financial statement sign करते हैं, on the right you are seeing the management signing. On the left, we sign, but we put a very, very important line before we sign. As per our report of even date, and then the auditor signs. It is a very important line. We all know of it, but many times we forget it. Sir, our signature to financial statements doesn't mean that I attest to what is given on top. It can be a case, a classic case, the entire balance sheet is wrong. Assets are overstated, intangibles don't exist. I will still sign the financials, but I will give probably a qualified opinion, an adverse opinion, or a disclaimer of opinion. So the point is, financial statements should be read in conjunction to my audit report. I am signing them only to confirm that मैंने जो audit numbers पे किए ये वो हैं. these are right or wrong, please refer to my audit report. So similarly, Joshi sir, in case there is a company where they require a provisional set, they want to give it unaudited financial statements for the bank. I always say this to members. There are provisions within our scheme of standards. You do not have to say no to any professional work. The only question is, do it within the ambit of these standards. For these specific cases also that we are discussing, you want to give a provisional financial. There is a beautiful standard of SRS 4410. That is, these are related service standards, because this is not assurance. मैं कोई audit नहीं कर रहा, मैं review नहीं कर रहा. I am only doing a compilation service, that is to say, preparing from the ledgers a financial statements, maybe distributing it current, non-current, making it in the particular format, and issuing it for the bank. I do not issue an opinion, so I don't say true and fair or my opinion. I don't issue a review report, so I don't say nothing has come to my attention. I simply state that I have done a compilation. So for those members here, जहां इस साल फॉर एग्जांपल आपके क्लाइंट में टैक्स ऑडिट नहीं आ रहा, बट क्लाइंट कहता है कि मुझे बैंक में एक फाइनेंशियल स्टेटमेंट देना है, आई रिक्वेस्ट अर्ज विथ फोल्डेड हैंड्स, प्लीज डोंट सिंपली साइन एट द बॉटम and say unaudited and issue it. Always accompany any financial statement with a report. In this case, if it is a provisional financials, please issue a report as per SRS 4410. At the bottom, mention as per our report of even date and issue a report under 4410. So to conclude, for provisional or compilation of accounts, the standard which is going to be applicable for us is SRS 4410. And for prospective financial statements, the standard which is effective and which I urge all of you to use is SAE 3400.
Thank you, Aniket, for explaining SAE 3400 and SRS 4410. We failed to follow them. We generally write extracted from the trial balance produced to me or compiled from the trial balance produced to me. So if it is a compilation engagement or whatever engagement, nobody understands what your signature is for. So as you rightly said, report is a must. And then the reader will know what you are trying to sign. Not certify, but what you are signing, that they will know. Sir, I come to sir, and I'm sorry for making you wait for a very long time, sir. I think I should have invited you at 10 o'clock or thereafter, but I thought you should be there since the beginning, because the question, sir, asked to you is very, very typical. Sir, you were, sir, a vice president and president. That time you were a part of... you were part of disciplinary committee of the institute, and now also you are a part of disciplinary on behalf of the government as government nominee. Sir, what are the errors we chartered accountants are doing in not following the standards, standard or auditing, which you get revealed in the disciplinary proceedings, and then you are having no choice but to give some judgment against the chartered accountant in spite of your best effort to first promulgate the standard. You were a part of NACAS and you helped us promulgate the standard. So you started, you are promulgated standard, you are giving lectures on implementation of standard, but unfortunately when you are in disciplinary, you see that they are not being followed and you have to issue some punishments or with a heavy heart. So can you tell us which are the auditing standard we generally don't follow at charter, and what guidance you want to give us as a past president as well as a person on the disciplinary for a long time?
Thank you, Shriniwas, and thanks a lot, Saket, for providing this opportunity. And I can only say, Aniket, I feel humbled by all your good, kind words. That's all I can say to you. And I have always maintained, and I will continue to maintain, that probably you are one of the bright stars on the horizon of this particular profession today. It is not like you scratch my back, I scratch yours. I can tell you, and I have been saying it, I didn't say it today. I've been saying it right in the presence of maybe thousands of the people. I think the point which has been brought in by Shriniwas ji is what are the kind of errors that our members commit in the various standards. If there is one, I would be very happy. But if there is everyone, then what to do? I think that's our unfortunate part, if you really ask me. The kind of errors which the people are committing, I think there is, you sometimes feel that whether we have actually pronounced any of these standards and whether people read it. And I think there the statement of Aniket becomes very relevant, that you have taken this task upon yourself to organize a sort of a program on this kind of a topic. I tell you, people are not willing to read either, particularly the auditing standards. Accounting standards, they must still be reading, forgetting that accounting standards compliance is the responsibility of the management. It's not my responsibility. I'm only supposed to comment if they don't comply. Whereas auditing standards compliance is my responsibility. And I think my kudos to Aniket for really raising this issue, that when a capital gain of 3 crore or 4 crore or 5 crore or 10 crore of a client happens, I am really worried throughout the night. I have sleepless nights that whether he will be paying the capital gains or not. But when it comes to my own discipline, I'm just not worried. I'm absolutely sleeping comfortably. And I sleep comfortably because I want to make my client sleep comfortably. I think that's the entire issue. And after some time, when I receive the disciplinary committee notice, I become totally uncomfortable. Today, I can tell you one thing, Shriniwas ji, that the complaints are not being filed by the chartered accountants against each other. The complaints are coming from the partners of the firms. When I say partners of the firm, not chartered accountant firms, the entities that we have audited. One partner is willing to part with that other partner and he complains only against the chartered accountant. And both the partners know what has actually been going on. Let's be very clear. And I'm unable to defend myself. One director complains against the other director. One shareholder complains against the other shareholder. The complaints are coming from the enforcement directorate. The complaints are coming from the CBI. The complaints are coming from the banks. The complaints are coming from the income tax department. And today we have virtually nowhere to hide. And there are certain standards we are absolutely unwilling to comply. Unwilling to comply. Let me put it that way. And particularly the way we are conducting, I think Aniket gave a beautiful example of SRS 4410. None of us has read it. I can tell you, any client comes in that my renewal is due, my review is due, I just pick up a stamp and fix on the financial statement and you take it. There is nothing like provisional. What is provisional balance sheet? What is provisional profit and loss account? Either it is from the books of accounts. Provisional is not coming from the air. After all, it's from the books of accounts, and that is where the compilation from books of accounts certificates you can get. There's no doubt about it under SRS 4410. But you have to give a report in respect thereof. I can quote you one case only, and I think you will make out what is happening in the entire profession. We got a case from Western region only, unfortunately, because I'm handling only Western region and Central region right now. The enforcement directorate has filed a complaint. They said that this gentleman has audited this particular, tax audited this particular client, a partnership firm. But we find that there is no such firm at this particular address. And when we inquire into the entire matter, and when this person appears before us, we ask him, where did you conduct the audit? He says, at my own office. Who brought you the books of accounts? One particular accountant. When the partners signed this particular financial statement, were you present? I was not present. Accountant brought it, duly signed by the partners. Did you ever verify the inventory? I didn't verify the inventory because I've told you I've never visited the premises. Did you verify this huge cash in hand? No, sir, I didn't verify because I was relying upon the management. Then how did you verify the inventory or valued the inventory, sir? I have written in the balance sheet as certified and valued by the management. If this is the audit, what else will not be the audit? Let's be very clear about it. He says, I have taken management representation. We show him SA 580. That SA 580 says that you can take management representation, written representation, but you have to test the veracity and authenticity of those written representations. And I can tell you with lot of, I can say I have a lot of concerns when even on the date of the demonetization, many companies, many firms, many proprietary firms have declared that huge cash in hand was available to them. And then they have gone and deposited it with the various banks, exchanging the notes. As on that particular date of demonetization, they have shown 50 lakh, 60 lakh, 1 crore, 2 crore cash. But even 5 days before that, if they were to make a payment of 25,000 rupees for the wages, they had gone and withdrawn the 25,000 rupees. Where was that cash of 50 lakh rupees? Where was that cash of 50 lakh rupees? Nobody has questioned us so far. If somebody questions us today, we have no answer to this. We have no face to show, very frankly, if you ask me. We continue to show in the balance sheet huge checks in hand as at the end of the year. And those checks in hand are not deposited for months together. Where are those checks in hand? I think these kind of management representations have no value. And then if I talk of the inventory, my standards are very clear that at least on one of the occasions, I should be physically verifying the inventory, not necessarily on the date of the, as at the end of the year. And then I must work either backward or forward to make sure that it is happening, that it gets reconciled. And I cannot keep on saying the stock registers are not maintained and keep on signing the tax audit reports. Then how did I reconcile these stocks? How did I reach that? What was the real case of the gross profit ratio? I think we are in a very different kind of world. And believe me, it is with a lot of heavy heart that one looks at all that. People have been certifying the value of the debtors, the value of the receivables for the case of the, in respect of the various clients for the banks. And unfortunately, I can tell you Aniket ji and Shriniwas ji and Saket and Joshi sir, wherever statutory auditor refuses to sign that and gets it signed by someone else, this itself is a sign that there is something wrong going on. We just came across a case wherein a particular chartered accountant has signed a receivable as on 31st December of 295 crores. And the total and the opening balance of the receivable was 55 crores. And the total sale up to 31st March from 1st April to 31st March was only 205 crores. What kind of a debtor certificate is being given? I can tell you, we have virtually breached every kind of an auditing standard. And the worst part is SA 230 and SA 500. Neither there is a documentation nor the audit evidence. We do not have anything of anything. When the CBI reports that this is all inflated turnover, and we call the auditor that how did you verify the turnover? Did you look at the total credit summations in the bank? You say the total turnover is 200 crores, but the credit summations in the bank are not even 10 crores. So then how the sale was taking place, how the payments were taking place, I don't have to say anything about it. So I can go on and on, believe me. Every standard, you talk of SA 230, you talk of SA 240, you talk of SA 260, you talk of SA 250, you talk of SA 500, you talk of SA 315, which was brought in by Joshi sir very, very nicely. I do not even have the document with regard to the nature of the business. Forget about anything else. Then how did I assess the risk? I do not know whether he was doing the retail business or wholesale business. If it is a manufacturing concern, my risk is different. If it is a trading concern, my risk is different. If it is a service organization, my risk is different. People do not have even document with regard thereto. I have been talking with regard to the relevance of auditing standards in tax audits. People do not have even the copy of the partnership deed. And the ratios have changed. And one partner complains that my ratio has been changed without even telling me. And the chartered accountant does not have even a document to justify that. So I can tell you, you talk of any, and particularly one standard that I'm unable to, and I requested the vice president yesterday also, day before yesterday, and I'm requesting you two council members sitting over here. SA 505, we are not complying anywhere, external confirmations. And everyone comes and says that I have applied, sir, I have applied the test. I looked at the internal control system was good, so I have not gone in for external confirmation. External confirmation standard says, if you have not gone in for external confirmations, tell us what are the alternate procedures you applied. When I talk of alternate procedures, it means how did you really look at the genuinity of the parties? Forget about everything else. Simply because the things were not going wrong, it does not mean the parties existed. Today, you will see it from the next year. I can assure everybody, whosoever is a part of this discussion, from next year when the aging of the trade payables will come in, particularly beyond 3 years, undisputed, what kind of notices parties and we will receive from the income tax department, I cannot even think of. Because if there is an undisputed trade payable of 5 crore rupees for last 3 years and nobody has paid it, I think there is going to be a lot of inquiries as to how this particular expense was booked. Let's be very clear, and there will be no audit evidence, there will be no external confirmation. So my humble submission is, we are sitting on a time bomb. Believe me, I'm telling you that. It's a ticking time bomb. We are not actually learning the lessons. We are absolutely not learning the lessons. And when one sits on the disciplinary committee, one feels so bad about it that we have to punish our own members for all these things. Thank you.
Thank you, sir. Thanks a lot for that scintillating short speech. We always like to listen to you long. Sir, you have rightly said we are really unwilling to follow auditing standard. And our dependence on management representation is an escape route many times. Aniket knows, and you know, I know that when we are in FRRB, Financial Reporting Review Board, we always resisted the notes to account, which are also referred as EOM many times by the auditors, is inventory is as taken, valued and certified by the management, as you said. And second note, we have always seen and referred to as EOM in many reports, including listed company report. Of course, in non-listed companies, you can say that it is, this second note is also there. Loans, advances, debtors and creditors are subject to confirmation. So you say confirmation standard is done because they are all, I said, nobody replied. Now, we say if loans, advances, debtors, creditors are subject to confirmation, what audit is done? The reader will know that there is nothing done, probably. And when everything is to be confirmed by outsiders, what insiders are doing and what the record shows us. You rightly said that there are other evidences easily available, that like credit submission in the bank account, which could have been seen to see that whether sales are all credit sales. So inflation in sales was so apparent from credit summation, which you said, could have been checked with inventory controls, whether there was a real inventory movement, or even in service organization where there were orders, where there were number of people working on those projects. What has happened? The auditor has not even gone into those areas as to see that there can be other evidences either to prove or disprove what is being shown. So I think it's, I think there is another aspect, sir. I'm not asking it as a question, but there is a KYC of client to be done. We jump at the client moment somebody recommends someone and or comes to us and say, yeah, I got so much income, without looking at the risk. And institute has come up now in 2017 itself. Ethical Standard Board has come out with KYC guideline. Know your client before you accept. And I think large firms are in this country are following it very rigorously and rejecting the clients where they have dubious record, or they have not following the standards in accounting, and the auditors also have not pointed out. And I think they are not accepting such things because they are at high risk. So with that, I think it was a very good deliberation. So there is a question which is there in the mind of all of us, and which is very, very relevant in last year, this year is that many of us are doing remote audit last year. This year also, unfortunately, second wave and expected third wave has a remote auditing from remote location has become necessary. And we don't have either the access to management. We used to discuss with management almost on daily basis. Management means various people in management. Daily basis, our issues. We used to go to the books of account, and we don't have books of account or financial records in physical form. Then how we test internal financial controls, or in this, how we should access, accept the operation of controls, etc. And really, what are the risks I am carrying, and whether auditing standard really support me in overcoming this particular difficulty. Any one of you want to start on this, because this is very, very relevant today, and even this year I expect more than half the audits to be done on remote basis, and people are not willing to go to the client and visit, especially in larger cities. So any one of you want to reply and start with that?
I can definitely start on it. Very frankly, of course, I would expect Aniket to deal more on it, because he has been leading the digital front along with Shriniwas Sharma in this particular council, if you ask me, and Manu Agrawal for that matter. See, the point is that we have seen last year what has happened in the bank audits. 2 years have gone by, wherein the bank audits had to be conducted on remote basis. Very frankly, we found our profession to be a little bit wanting so far as this particular audit was concerned. We may or may not like it to be said on a public platform, but that's what it is. And I personally feel no profession can grow without having a self-introspection, having a constructive criticism of its own, and then having to look the way forward, basically. I think somewhere or the other, people, particularly of our age group, have actually not been tuned to this particular situation. So far as the risks are concerned, remote risks are concerned, where is the cash verification? Let me be very clear about it. Where is the inventory verification? Even the inventory verification has not taken place. But of late, I can tell you, the inventory verification is taking place through the drones also. It is happening now. Through the photography, through the videography, it is happening now. Because people have really started learning the lesson. We can't leave it to chance that inventory might have been taken or inventory may not have been taken. And I think this year, particularly, last year the inventory could not be taken because nobody was prepared for that COVID, because on 23rd of March only the lockdown was declared. But this year, most of the people were actually ready for that kind of scenario. So through the videography, etc., the inventory verification has been done. So far as the books of accounts are concerned, if you have been given access through the system, if you have been given access to the system, and if you feel that there are sufficient internal controls that these systems will not be manipulated, I think that's very, very important at the end of the day, that the books of accounts which will be presented to you will not be manipulated in those circumstances. In that case, you may be able to rely upon the system. But looking at the kind of scenario that we have, and where the audit trail is not even available, and I think you look at the entire scenario today, the government has to come up with saying that from next year, unless your software really provides for the audit trail, will not consider it to be a valid accounting system. The government had to come up with this particular notification. We have not been able to enforce it, but the government had to come up with this. Because we all know what was happening. I don't want to get into the details. Basically, wherever the forensic audits have been conducted by the SFI or by someone else, they have come to a conclusion that many records were manipulated without any kind of audit trail. So if the auditor is satisfied that yes, the records can be changed, there could be certain adjustments which could be passed, but with sufficient audit trail, then there is absolutely no issue. But if you can find out that if you affect a particular change and the audit trail is not available, then I don't think that you can actually accept this on a remote basis. I think you are running a great risk in those cases. So my humble submission will be, we have to be far, far more careful when we are conducting this audit on a remote basis. And believe me, even exercising control on your own staff, whether they are actually working from home or not, this is becoming a major concern. This is actually becoming a major concern. One is going through at one's own office also all these concerns. If you ask me, you don't know for how many hours a person was actually looking into it. Now we are trying to devise certain systems whereby we'll be able to monitor the performance of the people who have been operating from home. Otherwise, the things have not been working in that particular direction. So I will like to stop here and then interject at any other point of time, as Aniket or Joshi have really come up with their own versions.
Aniket, to add to the question what sir has already replied, there can be modification in existing controls due to this situation, staff not being available, etc. Or there is a newly designed controls for this situation where there is a more dependence on information technology or such kind of control rather than physical controls which were there in the past. So we are more into either modification of existing controls or giving, say, as sir said, that I'm working from home, the authority is given instead of me to somebody else. I don't know how banks were working, especially in 2020, April, May, with only 2 or 3 people. And when a manager and accountant were supposed to have the keys of the locker, I don't know how they were really managing with none of them going to the branch, but still branches were working. I know that cash was handled. Less work was done. I agree they were not allowing operation of lockers, but there are controls issues there. When people are not presenting themselves, all IT information technology companies today, whole staff is working from home, and they will continue to work from home. So what are the things, as you know, you are an IT person, as sir said rightly, that there are modification in control or there are newly designed controls or there is more reliance on information technology. What you feel is how we can test them and how the auditing standard we can really follow in this circumstance. Well, how I can really do the audit itself is an issue. Aniket.
Thank you, Joshi sir. I think Amarjit Chopra sir has set the tone right. Let me tell all of the participants today are very honestly, sir is such a senior member, but look at the precision with which he knows about the changes in technology, the audit trail in the accounting software. And Joshi sir, I often give this example because only if we compare, we can understand where we currently are. You look at the medical profession, 1.5 years ago, maybe none of us did not know about an oximeter. And today we all know that oxygen can be measured from our finger. We never knew RT-PCR के नाक से भी टेस्ट हो सकता है सर. हम ब्लड टेस्ट से आगे सोच लेते थे नहीं थे. आज मेडिकल प्रोफेशन ने टेक्नोलॉजी सर, इवन इफ द डॉक्टर इज सीनियर मोस्ट, दे अडॉप्ट दिस टेक्नोलॉजी. In engineering, sir, we used to do, that line dori se banate the. Now you have latitude, longitude that they are using to mark the exact position. All professions have adopted technology. I think one important point I think that Chopra sir has underlined, and I would repeat, is we have to live in this new world where accounting is done through technology, and now auditing. COVID has forced us to even do audit using technology. So my request and urge to all firms, have younger members who can actually be well equipped with these technological aspects, get them involved in the audit process. I think a very important document, Joshi sir, I can refer to, and I think it's a matter of pride for me also, because as member of AASB, I was involved in that, is the document that AASB issued very early last year in April on using technology to come out with audit reports during the COVID period. We amended the requirement of the no objection, that is the prior communication with previous auditors, and we said you can do it through email. We allowed signature on audit reports. Open any listed annual report of April and May last year. All partners have signed using DSC. Because घर पे बैठे थे, printer तो था नहीं. They used DSC, appended it, and issued it to stock exchange. This is the level of technology where we are. And Joshi sir rightly mentioned, IT companies are functioning from home, and still their market cap has gone 3 times from where it was last year. So this, my only request would be that one, look at this wonderful publication of the AASB where it talks about technology. Sir mentioned to it the drones using video calls for inventory verification, and what are the alternate audit procedures. So agar March mein hum audit nahi kar paye, if you go in July or August, how you can reconcile and still go back to the physical inventory that would have been in March. I would also urge and suggest to all members, there are some very basic tools available online which you can all use to do the audit. I'm confident and extremely hopeful that we have this committee for members in practice, which is coming out with a software for audit of members. I'm hopeful that as a council, we can definitely decide on that and make sure it becomes a reality, because through that software also, lot of these requirements, especially Joshi sir, you rightly mentioned, for small and medium practitioners, how do you take the samples? How do you, use the technology for documentation, for audit evidence? That can be ensured. I will only say there are very simple things available today for you to use technology and get sufficient comfort. I'll give you one example. Joshi sir mentioned about the KYC norms of 2017. If you look at our SQC1, it starts with engagement, acceptance, and continuance. You have to know whether you should accept or continue with it. What many firms, Joshi sir, have already started doing, for example, is there is a website, many of you may be using it, zaubacorp.com. You simply enter the name of the director, and it will tell you which companies he is a director in which other companies in the same address, other companies are registered. It will show you which companies are striked off. So even before you accept a client, he walks up and says, accountant gives you the books and says, this is the client. In a 2-minute exercise, without spending a single penny, using technology, आपको उसकी बाकी की हिस्ट्री में जितनी कंपनीज में वो डायरेक्टर रहा है वो मिल जाएगा, उसी के ऑफिस पे एड्रेस और कौन सी कंपनियां हैं वो मिल जाएगी. And that is great information. You can use it for vendors, you can use it for debtors and creditors, because if you have companies which have strikes, which MCA has used the strike off option and removed them, and you still have a payable or receivable for them, it is immediately a question that must rise in your mind. So you have very easy tools available online. I'll definitely share some of them with Saket ji, and he can further, share it with the participants. But yes, technology will always, I believe, aid in the audits going forward, and it is going to become imperative for us as auditors to use them, Joshi sir.
Thank you very much. There is one question, and I can ask Ashutosh Joshi sir also on speaking on remote audit. He also must have done it. But one more question added there: whether scanned copies which are coming so often on the mail to us or otherwise, are they acceptable? And we are getting photocopies. And what are the risks in doing audit on that? A remote audit. This is related to remote audit. Scanned copies being very commonly now accepted by us as the audit evidence. Joshi sir, you want to say something on overall this subject as remote audit? It's extremely important.
Yeah. So remote audit has been going on since last year because of pandemic, and particularly in my case, if you all know, there was one old movie called as Kal Aaj Aur Kal, Raj Kapoor and Ranbir Kapoor. So I am a person who has seen the old days from my father's time in the firm and the way things were happening, which was more on the physical evidence based things. And now the things have changed. My son, he doesn't want to go physical way. And he would all the time advise me, go the electronic way and how we can do this. So I get at times squeezed between my old convictions about the work and the new ideas that they keep coming in from the new people. But nevertheless, I'll tell you, the young generation that is coming up is very innovative. They understand what the technology is. Only thing is, we as seniors, we need to have some control over how the things they appear and how they should be appearing. Say, for example, when we were doing this audit remotely, I asked them, I need to have a trail. So no matter you do it electronically, get it everything online and do it, but you create a trail for me so that I come to know as to what has happened since the time we started and till the time we reported. So we created a trail worksheet in which the trial balance at the early stage when we began the work was downloaded. And I told them that every time there is a change in the trial balance, the reasons for the change, the entries that are passed, and the documents that are underlying, I must have them for the review. And once the things were made clear to these guys, they saw to it that the entries were recorded, they were kept along with the worksheet so that we understand which accounts are getting affected because of the entries. And that is how from the beginning to end, we were able to keep a track on the changes that were happening. No doubt, having a physical access and a remote or a virtual access does make a difference. It makes a difference in terms of your confidence in the books that you are auditing or the environment that you are working in, because you are used to going to the client place and working there. And suddenly, if I'm sitting all alone in my room and doing everything remotely, it does take some time for us to accept that. But nevertheless, as I said, the young generation is very innovative. We need to place some reliance on them with the supervision and monitoring.
Joshi sir, if I can just add here.
Yeah.
See, in fact, if you look at the audit procedure, right, what we used to do, what are the assertions and what are the procedures? Inquiry, observation. I personally feel in the technology world, Joshi sir, we are better off in terms of audit evidence.
Exactly.
Because I'm looking at evidence not just from a 500 perspective, even from the Information Technology Act or even the Indian Evidence Act. Let's look at it from all three perspectives. If I have an inquiry, I have to come in. Earlier, I was going to the CFO's chamber, discussing my queries, writing his answers. Today, I'm doing a Zoom meeting, which I can record. It's a beautiful form of audit evidence for me to tomorrow say that I have done this. For my stock verification, I used to have a stock statement, summary sheet, and I used to sign, management used to sign. Today, I can have a video call, doesn't cost me anything, record it. It shows management is with me when I'm doing the inventory count. I am there, and I have a video which will last forever, which can prove I did what was required and expected of me out of my standards. Only point that you mentioned on scanned copies, sir. Again, my personal view here would be, you have to have your auditor's skepticism. For example, even back in the day when I was given a physical copy and I saw Sri Ram Traders and Sri Lakshman Traders, two different entities, but same font, same office address, I would think, sir, ye bill barabar nahi hai. Similar is the skepticism one has to have when you're doing a virtual thing. But sir, if the invoice is coming from the client, his IP, his email address, I think it is so much more for you as an auditor to prove tomorrow against any investigation that this is what I have done as a procedure. So I think we must not look at it as a hamper, but it is an enabler in terms of technology, Joshi sir, my personal view.
No, I personally feel, Joshi, that I wanted to give the same example which Aniket has given with regard to the invoice. Believe me, sitting over in the disciplinary committee today, when we talk of all this, we are getting cases wherein during the service tax period, an advertisement party has raised a bill of 40 lakh and it doesn't have the service tax content. So you can definitely, as an auditor, you can make out what is happening. It is not that you cannot make out. That professional skepticism is going to be there. So I personally feel, and another example which Aniket has taken with regard to the video recording. Believe me, today, wherever we sit on the board, and as audit committee chairman, I am feeling far more comfortable with regard to the issues that we are raising in the various audit committee meetings or in the board meetings, because everything is recorded now. But at the same time, you have to be far more careful in choice of your words also. So I think as an auditor also, you have to be far more careful there. But one thing I will agree with Joshi Ashutosh ji is that 100% today, if at all we have to value the younger generation. Believe me, if we don't value the younger generation today, we will never be able to value them again. And we will be the losers as a profession. Today, the seniors have to take the juniors into their fold. because these juniors have got the technology at their fingertips. We can only guide them as to what we expect from the technology. They will tell you what is the technology to be used for actually coming up to your expectations. That's very important. Somewhere or the other, unless we reconcile to the situation that senior has a lot of love and of course can utilize the services of the junior, and junior can have respect for the senior and can actually render those services, the profession is going to be poorer in the times to come. Profession can only become richer by the extensive coordination between the two, senior and junior. I think that's very important. And each junior today is a performing asset, provided we can make him performing. That's very important.
Yes, sir. Yes, sir. Sir, a related question to you, Aniket and all. A related question, that whether there will be definitely, sir, scope limitation. There will be definitely scope limitation in a remote audit. And whether EOM para or under 706 or under CAM under SA 701 will help us in coming out of the situation. And such a modification, whether it will be a routine thing rather than we call it a modification, whether it is a normal thing in COVID that people will be using CAM or EOM as an audit tool.
I will like to say, Shriniwas, that worldwide, the audits have been conducted more on remote basis. All Western countries, the audits have been conducted even, and these standards have prevailed. SA 700 is not mine. SA 700 is which has been given by AASB for that particular matter. SA 705, 706. If we start giving as an emphasis of matter in all the cases that the audit has been conducted on remote basis, I can only tell you that we will become weaker in our stand as a profession. We will be seen to be weak. We have to really make our people more skilled, and we must make sure that this does not appear. Because last year, believe me, I think you have been going to Reserve Bank of India. Reserve Bank of India has serious concerns about it. How can the branch auditor say that can keep on giving disclaimers because it's a remote audit? Then don't conduct it. You can't create a situation wherein your report will not be relied upon. If your report cannot be relied upon, why should the audit fee be paid for it? Let's be very clear about it. So I think we have to be clear that our reports add value, but at the same time, don't keep on saying that it's because it is remote based, so we are unable to take the responsibility. I think even if it is remote based, by assessment of the internal controls, the systems control, by the remote control, whatever I can exercise, I should not be getting into this. If I want to write somewhere, yes, the audit has been conducted on a remote basis, I may write it. That's not an issue. But it cannot be a modification or an emphasis of matter. I don't agree.
Yes, but sir, many people have used CAM last year. CAM. Yeah, CAM, because they said a remote audit was there, then these were the challenges, how they mentioned how they gone through with that, and they have also presented to audit committee what challenges they face. Yeah, Aniket, bolo.
Yeah, Joshi sir, I think I can 100% concur with what sir has said. And in fact, let me give you another parallel, sir. If, I think what happens generally is there is a client, COVID is there, but COVID or no COVID, let's say his loan covenants are not being met. It's actually an account under stress. Auditors, instead of going through SA 570 and putting a note on going concern, we personally feel a general note लिख देते हैं कि COVID है तो मुझे मालूम. I would urge rather, sir, let's put a 570 note on going concern. अगर कोई आदमी बीमार है तो उसे बीमार कहने में कोई हर्जा मत रखिए. Tell that it is a sick entity, it is not in a able position to repay its debts, it will not meet its debt obligations in the near future. Putting that note, I think Chopra sir as a member of DC will agree, is far more, I think, better for us as chartered accountants, rather than just, like sir said, blankly disclaim that COVID tha to hame malum nahi. Rather, let's be specific. I think that would be my suggestion, Joshi sir.
Yes, Joshi, Ashutosh sir, you want to say something, or we will go ahead with the next question? We have less time. Can we go ahead with the next question?
Yeah, please go ahead.
Yeah. There are two questions, but one related question to what Aniket said has come up, that whether the effect of COVID-19 pandemic cannot be determined by the organization, or they believe, I repeat, they believe that there is no major impact on the business. How 570 going concern will apply, because going concern being a fundamental assumption on which the accounts are prepared. If that assumption, as you said, is broken, the whole concept of three fundamental assumptions, consistency, accrual, and going concern, if any one of them fail, obviously it cannot give true and fair view. If the accounts are this. So it is not probably only going concern. We say that this is not a going concern, it has other impacts. So when the entity itself says we don't know what will be the effect, or they say we believe that if there is not going to be any material effect, how we handle that in actual practice is a related question to what you said.
I will only like to say, Joshi, that there cannot be a very clear-cut answer to this. Let me be very honest. In this COVID period, there are certain businesses on which it will have a positive influence rather than having a negative influence. If you ask me, you look at the business of Amazon, you look at certain other businesses, they are all having a flourishing business because of this. You look at the digital payments for that particular matter, but you look at the business of the tour operators, you look at the business of the malls, you look at the business of the theaters, you look at the business of the amusement parks. Now, if I'm handling any of such clients, management may keep on saying that there will be no material impact. But I, as an auditor, will definitely like to study it. After all, under SA 700, I've been given a responsibility of really commenting upon the going concern, assessing what is going to be the impact of the circumstances on the going concern. So management you will have to first take it, what is management's feel, and if you also concur with the management, you agree with the management. But if you are unable to make up your mind, then you can give a disclaimer. But if you don't agree with the management at all, I think you will have to qualify the report in those circumstances. And believe me, today, there are a number of businesses, there are a number of business activities where I will be very, very skeptical about the carrying on with regard to the assessment of it as a going concern. So it will all depend upon, look at the aviation industry, the way it has conducted, look at the restaurant, the way it has, these have conducted, look at the hotels. How many 5-star hotels are actually suffering as a consequence of this? So it will depend upon the nature of the business that I am dealing with as an auditor, and then I will be able to answer it. There cannot be any clear-cut answer to this. And I think each auditor will have to undertake the evaluation on his own. There is no doubt in my mind. And if one initially thought that automobile industry is going to be hit very badly, but there was so much of built up demand with regard to the autos that immediately after the COVID was relaxed a bit, the demand went up. There was a pent-up demand actually for that. But now again, the demand has tapered off. So I think all those factors will have to be taken into consideration. It's very difficult to say what is going to happen. There are cases of the real estate where these are doing now well. There are cases of real estate where these may not be doing well. So it will depend upon client to client also, for that matter.
Yes. Anyone of the other two panelists? Otherwise, we are okay. We can go ahead with. We are about to close because of we are overshot the time. The last question, sir. Many times there is one phrase used called professional skepticism in audit. Very commonly used. But we don't know really what this phrase is all about because it looks like a jargon. And the auditing standard, I think against accounting standard, AS was very, very easy to read. And Ind AS becomes difficult when you have a language issue as to understanding and the way it is presented. Similar issue is when I was young and looking at auditing standard, I could have read the standards in plain, simple English. The evidence standard was so simple and good that I could have easily understood what evidence. Today, every auditing standard adopted from internationally is very small, with several paragraphs to be read in line with each para. Each para will say read 823 to 827. Another para will say you read this to this para. And then, it gets disconnected. You read the standard first, you read those paras, then how you connect. So there are issues in that. And there are jargons. These jargons were less when we studied CA. They were less. Now these jargons have entered these particular standards. So professional skepticism is something supposed to be extremely important for audit, and it's stated in the SA 200. Now, what is this professional skepticism? How we use it in practice is the question.
I would like to question Aniket that under India's 113, Habu, highest and best use, what kind of professional skepticism I can use there, very frankly. The fact remains, you see, one way of looking at it is that when I start the audit with a viewpoint that there is bound to be a fraud in this particular client. That everything that I look at it with some kind of suspicion. And if I start looking everything with a kind of suspicion, in that case, I am going to fight out with the client. Every CFO, every GM finance, every AGM finance, DGM finance is going to be at loggerheads with me. I will not be able to get any information. Let's be very clear about it. I think one of the arts of the auditing is you should be able to get the information from the client without any obstacle, without any hindrance, without their suspecting as to what you are thinking about it. But at the back of your mind, you always have some kind of professional skepticism in the sense that you have that inkling where the things can go wrong. And that is where the 315 came into play, actually, very frankly. I'm studying the entity, I'm studying the processes, but I'm trying to find out in which process there can be major issues, basically, without even conveying it to the client. And then I improve my entire checking. My substantive checking is more in those particular areas. That's the kind of professional skepticism that I want, basically. I don't want to be suspicious on each and every point that I do. But if I am able to understand the entity better, if I am able to understand the processes better, if I am able to understand the integrity of the promoter better, in that particular case, I think my understanding with regard to what I am supposed to do to really, you can say, mitigate my own audit risk, that is my professional skepticism. So that's all I will like to say.
Yes. Aniket, you want to say something on this?
I think, sir, Chopra sir gave us two examples of what is not professional skepticism. And I would like to define it with that. He gave one very good example of management representation. Management ne kaha aur maine maan liya. That is definitely not your auditor's skepticism. You should have thought whether what he's saying is correct, whether I can corroborate it, whether there is other evidence available to negate that. And I think the second example he gave of the invoice without service tax. Now, just to accept, you may have kept the copy of that invoice in your audit file. But what was missing was your basic auditor's skepticism to see whether that invoice is actually genuine. So I think that question was effectively answered by sir in the earlier two examples. And I think what he has said, I totally concur with him.
Yes. Actually, the whole problem came in the statement in SA 200 before professional skepticism. Its statement is the auditor may accept records and documents as genuine unless the auditor has reason to believe to the contrary. Is the statement, and this statement is where everyone feels safe. अरे मुझे कुछ मिला ही नहीं, तो क्या करना है? I mean, we are hiding behind this statement without reading the next line. It says, nevertheless, the auditor is required to consider the reliability of the information to be used as audit evidence. This is a continuing sentence, which what is the reliability of the audit evidence? Or it also talks of saying the professional skepticism that audit evidence which contradicts with other audit evidence that you got needs this. Professional skepticism is that you can't hide saying that I accepted the record as genuine because I had nothing to believe, because there are reasons to believe there is a possible fraud. And I said 143 subsection 12 also possible frauds are required to be reported. Now, therefore, there may be circumstances which suggest the need for audit procedures in addition to those required even by SAs. You may have been told to do this or not. This video, for example, it was never there in SAs. I mean, one of the things somebody has said that our SAs need total revision for many things, especially in days after it came. How we really, whether it affects our SAs in any way, or only accounting standards are affected because it's a different way of this. But suppose you are going in fair value, whether our auditing standard tell us how to go about fair value checking, etc. We were recently on Schedule 3 guidance note division 1 to 3, and most of the people there talking was about the audit. You know how I audit this out. I continuously as a convener had to tell, sir, we are writing a guidance on the account, on the disclosure in Schedule 3 for the company. It is not audit. We want to write another guidance to the auditor on new Schedule 3. That is AASB will do. This is AASB job to give a, but we are doing it through CLCGC. But like this, there are several issues, and all of you have done well. Joshi sir, if you want to say something, otherwise we'll close. I also have a flight to Delhi. And
I will just give you one example, boss.
Yes,
I will just give you one example.
Yes.
Another disciplinary case wherein hotel bills of 5-star hotel bills had come in without a luxury tax.
Oh. So that was very.
So if you as an auditor cannot even think of a luxury tax to be levied in the case of a 5-star or a 7-star hotel, what kind of an audit I am doing, or what kind of professional skepticism I am having? So I think whatever examples you gave, those are absolutely fine. But somewhere or the other, we need to go beyond the transaction. I think professional skepticism is where you can think of certain things beyond the transaction. I think that's very important.
Yes.
So if you go beyond.
Sir, yes, sir. Sir, we got a lot of petrol bills claimed when there is no petrol vehicle in the company. All vehicles are diesel vehicles used. I mean, this is very simple thing, that how petrol bills are being presented by the people there and claimed lakhs of rupees when there is no petrol vehicle. All company was owning was diesel vehicles for the use of the company. So such professionals, I think very few people have. Somebody said that he went to a small place called Ratnagiri in as a person, the persons were traveling, these sales people, and he was charging 1,450 rupees per day for staying there every day. Then someone who was from Ratnagiri said, no hotel there is available of more than 450 rupees. That means he has added one. He made 1,450 of 450 bill. Because if you have that kind of issue, that it can't happen. When in Mumbai I go, I cannot have, say, more than 1,000 rupees from end-to-end taxi. If I claim 3,000 rupees, professional skepticism is challenging something which is not, it doesn't fit into your mind. And I think that is where we can. But I think we have done wonderfully well. As far as I think, all the panelists have done extremely well and telling us about this. I thank all of them together. And we'll continue with this. There were several other questions even asked by the participant. I think for the want of time, we'll close and we'll continue this discussion in some other program. Thanks a lot. Thank you all. Thanks a lot. Yes.
Very much.
Over to Saket.
Thank you so much, Saket.
Thank you, Saket.
So much, sir. On behalf of Nagpur branch as well as Auditing Assurance Standards Board, it was a wonderful interaction, and nobody would have really wished that it should end, because that word which has come in the end, professional skepticism, that is going to remain in our minds for long now. Because, and that example of petrol bills, yes, that is going to really tingle out something more on that. So thanks a lot. Thank you so much, Amarjit sir, Honorable Past President sir, for your effective deliberations. Honorable Central Council members, Aniket, Talati ji, the Vice Chairman of the committee, Shriniwas Joshi ji, and our own Nagpur guy, Ashutosh Joshi ji, for sparing their valuable time, as well as all the participants who have been there in large numbers to attend this 3-day National Conference on Auditing Assurance Standards Board. Nagpur branch is definitely privileged to host this conference. And thank you so much to all of you and all the respected as we close off the meeting. So all the presentations will be shared to the participants in due time. Thank you so much.
Thank you. Thank you all. Thanks a lot.
Thank you.
Yeah, thank you.